Thanks a lot, immediate past president sir, and the chairman sir for giving the opportunity for the IND AS series. Now we are starting the IND AS series. You heard the speech about Sunil sir, and this is a memorable experience for us, and also a memorable experience particularly for me, that in my committee these sessions are starting. And also we are grateful to CA Jaimin Panchal, who gave his consent to take the first session in the new auditorium. I request Jaimin sir, please come on the dais. Let me give you the brief introduction of Jaimin sir. Actually, the Ahmedabadi people does not require, any introduction for the Jaimin bhai, but it is a protocol that we have to give the introduction. Jaimin bhai has worked with the BDO. Right now, he is working with the BDO. He has also worked with the KPMG. His niche area of practice is CFO services. He has done work for the IND AS IFRS a lot, conversion from the US GAAP to IFRS. He is in practice in this area more than a decade, and he served the profession for more than 15 years. So with this brief introduction, me and Secretary of the Branch, Sunil sir, would like to welcome with the memento to the Jaimin sir. એકચ્યુઅલી મારા કે સુનિતભાઈ જેવા યાદ ના અપાઈ શકે, પણ જે ફિટ માણસ હોય એવા ફેનિલભાઈ જ ફિટ માણસનું ઇન્ટ્રોડક્શન યાદ કરી શકે. The first Iron Man in the CA community from Ahmedabad is no one other than CA Jaimin Panchal. 2 months before he did first Iron Man. હું ડિટેલમાં કહું એ પહેલાં હું જૈમિન સરને જ રિક્વેસ્ટ કરીશ કે બિફોર સ્ટાર્ટિંગ ધ સેશન હી શુડ ઓલ્સો ડિસ્ક્રાઇબ વોટ ઇઝ કોલ્ડ આયર્ન મેન, because I know something but I may not give that kind of description because my fitness does not permit even to give the description of the Iron Man. So I request Jaimin bhai to give the description of the Iron Man and also start the session. Please, sir.
Am I audible? Yeah. Thank you Rinkesh bhai. Thank you so much everyone. I am literally overwhelmed with what we have just seen on the stage. I am also lucky, just like you, the first movers advantage, that going to have technical IND AS session in this IND AS series for next 5 days, and again a very important as well as my favorite topic on consolidation. But before that, as Rinkesh bhai asked me to talk about what is Ironman, if you would like to know that, then Ironman is called as a triathlon. It's one of the longest endurance race that happens in the world, and it happens in various countries. So what it entails is you have to do a sea swimming, open water sea swimming. The distance is around 4 kilometers. Immediately you need to complete 180 kilometers of cycling, and then immediately you will have to finish the full marathon, which is 42 kilometers. I did this in the recent August at Tallinn, Estonia in the Europe, which is near to the Finland, and I could finish that in 13 hours and 19 minutes at a stretch. So Rinkesh bhai, aatlu chalse? Otherwise, I can take a session on that as well. We'll keep a separate session on that. Okay, so thank you so much everyone, and a very warm welcome as well as good evening for the today's inaugural session on the 5 days IND AS series. As we know, the topic is the consolidation. It is more on the IND AS side than the IGAP. So we will focus all the important and technical aspects and the concepts around the consolidation, the procedure, the technical aspects around when to consolidate, how to consolidate, as well as we will touch upon the associate and joint venture related accounting treatment as well. And we will also cover all these topics and the concepts with all the illustrations and the examples so as to make it simple. As we know that right now in India, we are having two gaps. One is IGAP, the old accounting standard which we studied more or less as a part of our curriculum. And since 2016 onwards, we are also having the IND AS, which is more or less the converged IFRS, and they have been converged from the ongoing IFRS which is there right now prevailing. And we are looking at the IND AS is also evolving so far as the way we are evolving, our nation is evolving, the economy is evolving, the business transactions are evolving. Similarly, we have the IND AS is no more like still getting influence from IFRS, but we have our own guidances as well, which is given by various committees, ITFG bulletins, and the education the committees that the institute is having. So we will cover those aspects also, and because of that there are caveats and the deviations so far as the IFRSs are concerned. Now looking at the overall topic, IND AS 110 is the standard which we are going to more or less cover the consolidation. IND AS 111 is with respect to the joint venture, and IND AS 27 is for the separate financial statements accounting, and IND AS 28 is talking accounting. The corresponding standard under IGAP is AS 21 and AS 28, and there is some bit of AS 14. Now AS 14 is more on the amalgamation when there is a transaction of merger, acquisition, demerger, or business acquisition type of transaction, or a restructuring of various companies merging to one within the group. Then AS 14, those companies who are following accounting standard IGAP will follow AS 14, but those companies who are already on IND AS, as per the phase manner implementation by the MCA done in 2016 and onwards, they will follow the IND AS 103. So in today's session, we are not going to cover IND AS 103, which is a business combination, but the element of IND AS 103 will be covered from the perspective of control definition, because the definition of control is common so far as 103 and 110 is concerned. Apart from 103, we are going to cover all the principles, and that's why I say it's a suite of all consolidation standards that we are going to learn about it. So before I start, I have a habit of asking. So if I can hear anything from you side, let's make it interactive. And the first question is, what is the core principle of consolidation? Or if I can just catch some of the words so far as this standard is concerned. Anyone?
When a particular company acquires a particular stake in another company, the holding company will consolidate the profit and loss and balance sheet into its own separate financial statement. Meaning thereby that the consolidation will be done only after the stake has been acquired.
Okay.
Interest is more important if we go for the consolidation purpose.
Perfect. Anything more to that to add? Yes, sir.
Common control either financially or otherwise.
Okay. This is another one. Common control either financially or otherwise. We will touch upon that.
So if you have a common board of directors across the company and those directors are controlling even the other entity, even that qualifies for consolidation.
Okay. So as to say that the relationship of various entities or how the entities are connected to each other, and that's where we need to assess whether which accounting standard to follow. Okay. Anything else? Anything related to this topic? Whatever comes to your mind. Okay, what is the requirement of preparation of consolidated financial statement first of all? When it came up, when it arisen, why it is required? Where is it written that you need to have the consolidated financial statements? Companies Act, yes. Companies Act mentions that. Okay. So Companies Act 1956 did not mention that. But Companies Act 2013, when it came into existence from 2013-14 onwards, it was mandatory to have the consolidated financial statements as a part of the company, parent company's, financial statements, ROC filing related, and it is required to be filed with the ROC. So standalone financial statements, anyways, we all aware about it, but then console was also required. Apart from that, SEBI, LODR and the SEBI regulations also required console financial statement for all the listed companies. So earlier, if I see erstwhile era of 2013 and before, it was not mandatory for all the companies to prepare the console financial statements, but only for the listed companies it was mandatory. But when 2013 onwards the act came in, it becomes mandatory for all the companies, including private limited company and public companies as well, which were not listed. And during those time, there were lot of changes that happened, the way the reporting is required to be done. And immediately 2 years later, the IND AS kicked in. The IFRS regime of preparation as well as the reporting has started. Why this context is important is because I have been witness to certain public sector companies which are sizable in nature. Okay, when you say that if I put that public company into overall Sensex, then it becomes a huge I would say that contributor to the overall wealth maximization. And those companies were never prepared consolidated financial statements. Now, overall, the concept of consolidation comes from the one economic entity at a group level. And that's the basic concept, that how the stakeholders would look the financial statements of the group at a group level. So it will have different entities within the group, and consolidated what is the value which has been arisen on. Right? So that's the overall concept so far as the IFRS is concerned. The second is, in IFRS, more emphasis are given on the consolidated financial statements at a group level rather than at a entity level. So whatever accounting standard in IFRS is you are going to study or implement on a practical life, they will be seen more or less from the group per se, as an economic entity and not at an individual entity level. Superb, thank you. So now, coming back to when the consolidation will kick in. So I will go back to 103 IND AS 103 business combination. When any business is acquired or entity is acquired by way of transferring the purchase consideration, the purchase consideration will be transferred from the transferee company to the transferor company. It may be in any manner. Maybe the shares are flown from one entity to another, or a consideration in cash or any other form, as the case may be. Once that happens, then the business or the entity has been acquired. Now that date is important from where the consolidation is required. Now day one accounting, the acquisition accounting is written in IND AS 103, which is a business combination. Post that, every reporting date, the consolidation is required to happen in light of IND AS 110, the consolidation. So 103 at the time of acquisition, post that it is always 110. The day one goodwill will be calculated at the date of acquisition. Again, there are various definitions given. Who is the acquirer, who is the acquiree, what is the date of acquisition, what happens in case of the court approved scheme or NCLT approved scheme, which becomes the the acquisition date. These all are there, which we are going to talk about it. The second is, at the year end, when you apply the consolidation principle, you have to follow 110. Starting from the acquisition date. Once that year is passed on, then every year it becomes a routine exercise of consolidation, and you will follow the consolidation procedures. Generally, So this is what I was talking about, is a concept of group as an economic entity. So you will have a parent, you will have a subsidiary, you may have a joint venture associate. We are going to talk about how do we establish the relationship, but this entire becomes a group, and at a group level what is the economic entity structure that is going to be considered for the consolidation purpose. Generally, features of a group is it's a single unit. It has the same year-end financials to be brought in. Intercompany transactions are excluded. Same accounting policies. The standard talks about that if there are change in the accounting period, if it is less than 3 months, then that is fine. But if it is more than that, then you have to align the accounting period. Generally, accounting policies are aligned so far as a group level financial statements are concerned. Now, one question I always come in mind that when I do consolidation at a parent level, parent has its own accounting policy. It has 5-10 subsidiaries. It has its own separate accounting policy. When I consolidate, which accounting policy I need to follow? If there are different in accounting policies, that may be possibility because let's say I have few foreign subsidiaries in their their countries, they are following their local GAAP. I am following IND AS. Then at a consolidation at India level, what accounting policy I should follow? Parents consolidation policies. Okay, so subsidiaries policies is to be disregarded and we have to follow the parent accounting policies. Is that what you are saying, or anything else to improvise this answer?
Actually, we need to control the accounts according to the parents' policy. Talk about India and India.
So practically what happens is, practically we tend to follow what the parent follows. And that goes from the parent to all the subsidiaries to follow the account as far as the accounting, the consolidation is concerned. But there is no written, statement anywhere in standard that it has to be a parent accounting policy to be followed. In which case, the practical approach is whatever is the uniform accounting policy at a group level is required to be followed. It may be a little deviating from the parent's standalone financial policy as well. The probability will be very less to deviate from the parent's standalone financial accounting policies, but from the standalone financial accounting policy may be deviating. The simple example is that, my company is a telecom company, right? I am giving the various data services. I have a subsidiary who is a tower company, so who lay down all the towers. Now, my IT system at a entity level, those intangible and tangible assets may have a different useful life and the method to follow from the inventory or a PPE standpoint. But my subsidiary specifically from the perspective of its business may have a different policy so far as its PPE and the inventory is concerned. And at a console level, I may not change that because it is not required to change, right? So that is what the main concept is, that uniform accounting policy is to be looked at a group level, what is the correct accounting policy to be followed, and then it is to be applied consistently. Okay, now one of the important aspect when I need to consolidate is the date on which I acquire the control. Now what do you mean by control? Earlier under IGAP, what were the principle, if someone can tell me? So right now we are talking about a parent and a subsidiary. The relationship between parent and a subsidiary is required to be established. Under IGAP AS21, what was the principle given which makes parent to consolidate the subsidiary? More than 50% of the shareholding pattern, then you have a control. Then second, so majority of the board of directors, right? So more or less it was a principle based, rather than, it was more of a rule based rather than a principle based, where if it is anything more than 50% is held by one company or the majority of the board of directors are by the parent company, then it will be consolidated. Rule was applied. Now there were situations we faced at the time of IND AS transition, that there are so many entities in a huge conglomerate business companies where they have a joint ventures, and those joint venture companies the JV agreements do not mention that it is a joint venture per se. They are more of a shareholder agreement or an agreement or a MOU between two companies, where 50 is to 50 or 50.1 is to 49.9% is the sharing of the this thing, right? And the second was from the voting perspective, from the board of director perspective, again it was more of a equal standing by both the companies. Now just merely having one more share which makes more than 50%, the companies used to consolidate as a parent in its books of accounts under a rule based accounting of AS 21 era. Now imagine a company who has been consolidating its, one of the company who has a 10,000 of, a top line and 2,000 of a bottom line, and the consol financials is very strong by that. And on a day 1 to 2016, IND AS comes and say that you do not have to consolidate, considering that it becomes a joint venture or a jointly controlled entity rather than your holding company or your subsidiary company. So the top line is gone. The bottom line is accounted as your share only. And these were the impact we have seen in many big conglomerate companies, and so many impacts they had to take it because of this definition. And that's why the starting point or a gating question for us into consolidation is when I say I have acquired a control. Okay, so forget about the rule based, now it is more of a principle based, and the definition which we are going to talk about is this. An investor controls an investee when it is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. So it is 3 steps. One is power over the investor, okay. The second is exposure to variability of returns, and third is the ability to use that power. So link between you have a power as well as the variability of return. Now let me just simplify it. More or less we know that how, with what eyesight we invest into the company, but we are investor, retail investor. Think from the perspective that why a businessman or a company invests into another company with some objective, right? Or either they are going to get some synergy benefit, either they are going to get some contractual benefits, in future business will improve, they will get the new brands in its portfolio, they will be able to cater to different geography, etc., right? So there are different objectives through which the company will acquire the other company. Are you with me? Now how to understand that what is the real objective for that entity to acquire it? Because we have seen certain entities being acquired which are loss making entities, isn't it? Then what is the motivation to acquire a loss making entity? What is the motivation to acquire an entity which doesn't have anything but only land in its books of accounts? Right? So the main important aspect is to understand what is the objective of that entity which is being acquired, and what is the objective for the company who is acquiring is going to get the benefit out of it. Right? So for an example, a telecom company, what is its main object is to provide the data, provide the seamless services, right? Any trading, any manufacturing company who is into the F&B products is to serve their their products which is at the best quality to the and get the maximum market for those products, right? Any shoe making company, what is their best objective is to create the brand, get the maximum sales done and get the maximum profits out of it, right? So from the objective and the purpose of the business of the entity, you will understand that what are the critical, important, relevant activities in order to serve those objectives of that entity, right? If one needs to cater to a new geography or a new product, then that becomes one of the important activity on which the business is going to rely on, or the maximum weightage or the focus is going to be relying on, right? Similarly goes back to an entity acquiring the other entity with what objective is very important to understand. Once we know that, then we will be able to lay down that, okay, this is the objective of the entity, this is the main purpose of the entity, these are the 10 relevant activities. If I have a right to take a decision on those important relevant activities, that means I can control that entity. Are you with me? Right? So for an example, if I'm a, I'm a, businessman, I'm a chairperson of a company who is manufacturing shoes, which is Nike, for an example, right? And I know that, the market in India is going to boom, so far as my shoes are concerned. So what is my objective is to increase the market here in India, for which I need to take a lot of policy decisions, a lot of operational decisions. And if I have that right to take those decisions to cater to Indian market, then those becomes my relevant activities, right? So if I can have a right or a power to take decisions on those relevant activities, then I can say that I have a power over the investor. I have a power over the investor. So that is first. The second is exposure or rights to variable return from the involvement. So by taking lot of actions, by taking participative actions, controlling actions on those relevant important activities of the company, of the business, what I will get out of it is the returns. My returns may be in different forms, maybe profits, maybe dividends, maybe wealth maximization, maybe synergy impact, maybe tax shield that I am going to get it, right? Maybe brand which I am creating, maybe awareness which I am creating, maybe catering to new geography is what I am looking at it, right? So this is what the return that I am aiming or expecting by doing those, controlling those relevant activities. That means I am exposed to those returns. The returns is always positive or it may be negative, right? That's why it's called variability of return. Now when I say variability of return, I may be exposed by taking decisions, I may be exposed to positive return, I may incur losses as well, and that's why the definition talks about the variability of return. Now when I combine both of this principle, that I have a ability to do so, linkage between power as well as the exposure to variability of return, then I can say that I control the another entity, or I control those relevant activities of that entity, which gives me the returns in future in different forms which I am aiming for, and hence I control, and if I control that, it becomes my subsidiary. So it has to be unilateral control, okay, not joint control, and unilateral control comes with different forms that we are going to talk about in the next slide. But any questions so far as the control definition is concerned? Or anyone wants to add anything to this? No question? That means understood everything, or it's totally bouncer? Which one, A or B? Am I bouncer? How can we identify this? Yes, we are going to talk about it in next slide. Good question. So I just explained the definition and try to give you example on how to decipher the entire definition of control. Now practically how do we do this? When I say, yes sir. It would. Then we will go out of 110 and we will end up in 111, IND AS 111, when there is a tiebreaker type of situation. So, yeah. Yes, absolutely. So there are few examples which we are talk about where I have a 100% supply contract, where my all the manufacturing will be taken up by my another entity, but there is no other relationship. What to do? So we will talk about those type of situation. Okay. Okay, indicator of power. So 50% or more of the voting right, again that rule comes here because we need an indicator of how do we establish power. The second is definitely I have a power to govern various financial and operational policies of the entity, appoint majority of the board of directors, or power to cast majority of the votes at the meeting of the board of directors, or I have a veto power. I am a chairperson, I am a KMP who has a veto power. There are number of activities which are majorly important and contributed to the returns, variability of returns, for which I have a sole power, okay, as an entity or as a board of director. Then those are all the factors, are indicators that I am having control over the other entity. The existence and effect of exercisable potential ordinary share. So this is also important, that if I have a potential equity share, I have interest in the potential equity shares, then that also gives me a control or a power over the other entity. Now what is potential equity share? Any example if you want to give? Then convertible debentures or preference shares, or I have a put option or a right option in my agreement that I have a right to purchase the other shareholders stake with the current market price, for an example, and that has to be in the money. All those options should be in the money. If that is the case, then what happens, that I have an ability to control you, because let's say in the game of my business I want to just take full control over it, right? Then immediately I will I will exercise my right out of those clauses of the contract, and I will buy the other shareholders out, so that I can have a full control over the entity. Okay, now this is an important chart, control model at a glance. So first is identify the investee, identify the relevant activities of the investee. It's actually hot, sorry. Okay, identify the investee. So I'm going to invest into the entity. Which is that entity being considered as a investee, and which is the investor entity? These definitions are there under IND AS 103. The relevant activity which I just gave you an examples of. Then identify how decisions about the relevant activities are made. Now assess whether the investor has a power over the relevant activity. There are two parts. One is voting rights are relevant, and the other is rights other than voting rights are relevant. Now voting rights are relevant, rights held by others where majority is with me, okay, and the rights to the other shareholder are maybe lesser or a minority in its nature. Then I become a sole shareholder who has the overall control. So anything more than 50% is one indicator. I am not saying that the sole indicator, okay, it's a one of the indicator that should enable me to control the other entity. The second is less than a majority of voting rights. Now in case what happens, that I am holding less than 50% of the voting share capital of the company, then what happens? Agreement with other vote holders. So what is the agreement with the other shareholders? So let's say I am 40% holding in one entity, and there are other three shareholders who are having 20, right? Now by virtue of some other contractual arrangement with the other shareholder and the shareholders agreement, there are few other indicators which gives me power over the entity. Let's say for an example, I have a right to appoint the chairman, and the chairman has a veto power. I have a right to appoint the main KMP. I have a right to approve the budgets. I have a right to approve the capex more than X amount, right? So even if it is a 40% less than the majority, because of the other contractual arrangement, because of other indicators, I still can say that I control the other entity. So that assessment is required to be done. The other contractual right, I just spoke of potential voting right. Again in the contract, if I have some call or a put option, or I am holding convertible preference shares, again in the money, all these options should be in the money. So far as in the money is concerned, that by doing that activity, by doing purchasing the other person's share out today, it is economically viable for me to do so, and I am not totally out of the money so far as the price of that shares are concerned. In which case the potential equity share becomes the indicator for me to consider as a control over the other entity. The next is the de facto power. The de facto power, any idea what is the de facto power? Can anyone give me the example of de facto power? No? Someone? Okay, what is de facto power is the situation where, let's say I am having 37% of the company's equity share, okay, and the rest is distributed among thousands and lakhs of investors, and none of them are holding more than 1%, right? And there are no possibility or there are no contractual arrangement between those shareholders that they come together and vote me out. Now by this scenario, I becomes the sole shareholder who has a control over the entity by the de facto control. And most of the larger conglomerate where they are highly diluted their equity in the public, in the share market, are situations having this, even at 27, 29%, because the others are highly distributed and they generally don't come together and vote me out. And generally they try to keep the ratio in a way that they generally have a control over it, and QIBs or FIPs are not so much invested into it. And again, they are invested into it, they have their protective rights rather than substantive rights on the business. So we will talk about what is protective rights and substantive rights. So de facto power. So one is the voting rights are relevant. So if you have a voting rights, maybe less than 50%, different indicators, more than 50%, again with other indicators, you can say that I have a control over the entity. The next is rights other than voting rights are relevant. So what are the other criteria or indicators? One is purpose and design, we spoke of that, I have a SPV. I have 10 SPVs so far as my business is concerned. The best is the green energy companies. Their model is what is the one entity, they have one infrastructure entity and then they have number of SPVs. At different locations those SPVs are built up. Now those SPVs will have their plants, the renewable energy plants, and those plants specifically in those geography and a region generate the power and they generate the revenue, right? Now those 100 SPVs are specifically for that purpose only. Now by virtue of doing this entire purpose and the the overall objective for which this SPV is done, it is solely controlled by the parent company. It may have equity, may not have equity, because that's the business at which the overall operations are being controlled. The next is evidence of practical ability to direct. Maybe here you can say that the relationship where one entity, the chairman and the sole shareholder, and the second entity where the son of this chairman is a MD of this entity, and because of this relationship and the supply contract or a manufacturing contract between both these entities, no shareholding pattern is there, but still it can be considered that the chairman may control the other one, considering other factors are there in place, and it can be established from the legality per se, from the perspective of some contractual arrangement or minutes of the meeting per se, how they are participating in taking various decisions in the business of the company. Assess whether the investor is exposed to variability of return is all pervasive. It's not like that at a point in time only this relationship is required to be established. So on a day one when you acquire the entity, yes. After the acquisition, yes. On the date of consolidation, which is a reporting date, yes. You have to see that the relationship should subsist throughout, all throughout. Then the consolidation is required, then you say that I have a control over the entity. Any questions so far as these indicators are concerned? Or anything which is not clear? Yes.
I just have one basic question. So, if a company is holding say 45% in a partnership form, then companies that say that we consolidate bodies corporate, but there is no clarity in IND AS whether we should consolidate a partnership form or not. So, what is yours?
No, so that's why they don't mention what is entity. So even partnership firm would be covered as a part of the overall group. So it's not necessary that you have to have a company in place from the Companies Act standpoint only. So IND AS never or IFRS never say that has to be a company in the some form. So even if it is a partnership firm, it is required to be consolidated. Even if it is a trust, then it is required to be consolidated.
And if a LLP is holding a company in a foreign geography, then consolidation is required.
LLP is holding foreign company. So for the LLP, yes, it will be required for consolidation from the MCA standpoint. So it's a LLP, right? So you'll have to file the consol financial statement. So yes, it will be. Yeah, from the MCA standpoint, yes. ROC filing standpoint.
So both the conditions, that is voting rights and rights other than voting rights, both are independent, right? Both states are.
Yes, both are independent, but practically those all are looked into together, and you have to draw all the indicators and say what are the ticked and what are not, and then take a decision on, rather than only emphasizing voting rights only. You may have 60% but may not have actual rights. Warren Buffett, he may hold 90% of the entity, but he will never go to board meeting. He will never exercise his power, for an example, right? So then in that case, you have to have the other indicators also to place a role that whether I will have a control over it or not.
So what will happen in this scenario where there is a contradiction between the voting rights and other than voting rights? That from voting right perspective, one company is holding the subsidiary, and from rights other than voting rights, like contractual arrangement, another company is controlling the subsidiary company. What will happen? Whether a subsidiary company will be consolidated in both the companies?
No, so in that case, you have to see what are the substantive rights and not the protective rights. See, when you say control, it has to be a unilateral control only. So the assessment from one entity and the assessment for the company B has to be same. It cannot say that company A will say that I have substantive rights over all the relevant activities, and B will also say that I have the substantive rights over all the activities. It will never happen. It has to be unilateral control. Otherwise, your assessment is wrong, or it has gone somewhere different tangent. And that's the reason you have to look at what are the relevant activities. You assess those relevant activities, who has a power over it. Somewhere down the line, either of the company will have power over majority of the substantive rights. Okay? In that case, it will be one company and the assessment will remain same for the company B as well. Now, in case this situation arises, then it is more of a joint control situation. Then you will be out of 110 and you will end up in a joint venture arrangement assessment. So practically, even by applying the standard theoretically as well as by practice, this situation will never arise. Otherwise, there is an issue in the assessment, right? So these are a few examples of relevant activities, and that comes from the purpose and the design of the entity. So determining or changing operating and financing policies, selling and purchasing of goods, selecting, acquiring or disposing of assets, researching and developing new products or processes, determining a funding structure, establishing operating and capital decisions of investee, appointing, remunerating or terminating the employment of key KMPs. See, these are again the indicative activities. Some businesses may have such activities as relevant, the other may not. R&D will be more specific to IT company or a pharma company, may not be for some entities which are purely trading company or a purely manufacturing company of some goods, right? So you have to see that from the purpose and the object of the entity, what are my relevant activities, and then I will put tick mark that whether I will be able to take decisions on those activities or not. Who has the existing right to direct the relevant activities? So this is again the examples of right to direct the relevant activities. So ability to make the decisions, again voting rights. The present right is important and not the future right. If it is a future right, then it's more of a in the money type of options, which are the potential voting rights. And it's an ability. It says it's an ability. You should have an ability to do that. It's not that you are doing it always. But if something happens or if you want to exercise your ability, you have a right to do that. That is important. You may have a, either appointment right of key KMPs, or you may have a removal rights, and those also become a substantive rights. To direct the investee to enter or have a veto rights. Okay, so when there is a deadlock, a chairman has a veto right, and if chairman say yes, it becomes yes, or no, it becomes no. In which case, the situation is totally different when it's actually kind of a joint control, but one has a, let's say it's a 50-50 joint venture in terms of everything, the investments, the profit sharing and everything, but one party, one entity has a chairman who has a veto right. Now, by virtue of that, you may come and end up saying that that entity has a control over the other one. Potential voting right, we just spoke of. De facto control also we spoke of. Now, this is important, substantive versus protective right. So, someone asked question here that how to do assessment of it, right? Now, in today's world, you will find some or the other way where the two parties contracting to each other. There will not be any oral, contracting done. So, there will be either some MOU done, or there will be shareholders agreement, or a joint venture agreement, or some supplier agreement, or a manufacturing agreement, where two parties will put various clauses so far as their arrangement or agreement is concerned, right? So, that is one base document which will be assessed in all legal aspects considering the light of this standards concept. So, that is first. The second is the minutes of the meeting. Okay. Why this is important is how the other shareholder or his nominee directors have performed or handled certain voting rights pattern. So, maybe last 1 year, 2 years, or currently how they are functioning in the board meeting. Who is exercising which type of power, who is the sleeping type of a director, who is taking the various important decisions. So, you have to assess those minutes and the meetings also. The third is practical way of having the discussions with the management and try to find out that who is actually the main person or a main entity behind taking various decisions of, right. So, these three are something which one needs to assess, go through, interpret it and document it, and then come to a real conclusion whether the entity has a substantive rights or not. Okay. Now, what do substantive right is important is by performing my right over certain relevant activities, variability of return will be highest or lowest. I may be positive, I may be negative, right. Those become the substantive activity. For an example, appointment of an auditor, will that be substantive activity? It could be, maybe for the first year, but for next 10 years or next 5 years, may not be, right. Appointment of MD, who is a technical MD, but doesn't have any power to vote at the board meeting. Okay, so one point here is very important is at what level we are looking at those powers to be conferred or powers to be exercised. Why I am talking about every time board meeting only? Because board of members or board of directors are those charged with governance. So far as our Indian economy, the way the Companies Act are there, right? And then it goes to one step ahead and look at the shareholders meeting at an AGM level, where only special agendas or the important agendas are only are taken up. And that's the reason I come to a board meeting only. There will be different other committees also, but those are special committees or special purpose committees, and for which the board gives the power for those activities to be done in those committees. And if anything above that will always come to a board, and that's why board becomes a supreme power, and within that board Which entities board of directors are having supreme power over various activities is important. And which I am saying that one company is having an MD who is a technical MD from the business technical plant standpoint, for an example, may not have a voting right, but he will always be there, which will become a protective in nature for the other shareholder.
Segment accounting, suppose when we look at peak results. So would that have some bias on that? When you said about this interlinkage in your opening remark, if equipment links with 103, would it also have that?
Yeah. So see that CODM approach under the segment reporting is also the same, that how the board looks their profitability. It would be more than 1%, but so right now what we are assessing is one company is having, so we are talking about at an entity level right now, right, where the situation is a little in between, where a company is having few board members and there are other companies few board members, and I am just giving you a hypothetical scenario to understand the concept. So in which case those charged with governance are the board of directors in the situation where we are in India right now, and may not have any special powers to any other committee except those specific reasons for which those committees are being formed right now. Okay, so where I was, okay, substantive rights. So this may become a substantive right or may not become, may become a protective right. But as soon as I will say that the company has taken a XY amount of loan from this FII or a bank, and they have a director on the board, then what? What is his role? You will ask. And then his role is more or less to protect the interest of the bank funds. So if company wants to further borrow, he will stand up and say that, hold on, what about my repayment, right? What about my interest coverage, right? But if the company is going for the other businesses, he will be sitting. He will be just a sitting member in the board. And that's the reason it becomes a protective right and not the substantive rights for that director. See, have you seen the public sector companies' board composition ever? All GNFC, GSFC, GMDC, then GSPC, Gujarat Gas Limited. Gujarat Gas Limited is still a listed company. But have you seen the board of directors there? The overall composition. 80 to 90% of the board of directors are the IAS officer or nominee of various departments who are majorly independent. By constitute, they are required to be a part of the board of directors of such PSUs, right? Now, in which case it becomes very difficult to understand if I have invested something, like let's say for an example, one PSU has invested into another PSU with 19% of the stake, and the board of directors are mix of all these independent people who are having such authority and the positions in the government. Now you have to assess, there is no agreement, there is no other relationship, there is nothing else. Then how will you say it is an associate or some control is there or not? It becomes difficult. We have done practically on this all also. We have some 19.99% stake and we have some supply arrangement into a PSU, and the question arisen by the CAG that this relationship is not accounted for. You have to account for as an associate, and the company never prepared consolidated financial statements because it has only one investment which is 19.19%. If they have the associate, then they have to prepare the consolidated financial statements, right? So absolutely, and that's why I didn't go for control. I said associate type of relationship in this example. Yes. So generally, government may have a control, may not have a control again, because government may give certain controls to various other authorities that they built, and that's how it is required to be assessed. But in this limited example, if I want to conclude, then what happens is company has never prepared a consolidated financial statement because it has never considered that as an associate or having significant influence. Why? Because they only had one board of directors representative there. Hardly that board member has gone and attended meetings, or hardly has taken any interest in that entity by virtue of government circular, they had to invest that much amount to facilitate that investment, and that's why company never did it. CAG came and say that you have to do this, you have not done it. They gave the EOM on that. So then this all comes and play a role. If you go for rule-based accounting under IGAP, yes, you should have done it. Under IND AS, you will assess it properly, put all your indicators in a place and then say that no, hold on. This cannot be consolidated as an associate. It is still a normal investment only in my books of account, and then the question arises, I should do fair value or at a cost. That's the second thing. Right? Are you with me? So it's not straightforward, it is highly judgmental, the way you apply it, the way the principle is laid down. If you do a thorough assessment with indicators, you will get to a correct answer only. So budget preparation or approving the budget generally becomes a substantive in nature. The loan related decisions are generally protective in nature. Appointment of auditor, again you have to see how the situation is, right? For an example, I should not name it, but let's say there is a joint venture between one foreign company and the Indian company, and in Indian company it is under NAFRA, right? And then appointment of a auditor becomes very critical and important, and then the foreign entity who is a joint venture has a right to appoint a auditor, may become a relevant and important activity from the overall assessment standpoint. Okay, again hypothetical or akin to something which I am trying to say, but yes, this type of situation is there in the practical industry right now. The capital decision, so how much to invest, how much to borrow, whether cater to a new geography or a business to approve the capex and do the capitalization expenditure, this all becomes a substantive in nature, because this is going to change the game of your business in near future if you take the decisions on. And if you do not take, then also it becomes a substantive in nature, that you will not get the variability of return so far as this all is concerned. So these all are the substantive in nature. Exposure to variability of return, as I said that synergy. Okay, what is synergy? What do you mean by synergy? Other than the financial benefits, right? So if you have invested into a company which is loss making entity, but it has a very good brand in the market, brand image, or at least its brand is across everyone's mind. Then for what you are paying that entity, it has a negative net worth, still you are making payment to that entity and acquire that entity. So you are acquiring brand by way of doing that, right? There are many examples, practically such kind of acquisitions that happen in the market. The second is definitely dividend becomes one of the aspect, but not always, because what is dividend is a residual interest. Okay, even if you do not get it as by way of declaration of dividend or payment of the dividend, at the end of life of the entity, whoever are the shareholders are anyways going to get what is remaining in the business, right? And that's why dividend may become a substantive or may not become a substantive return from the perspective of this assessment. You may have a let's say a company is having a land in its books of accounts, and I am a real estate developer company. Now if I am paying something to an entity, I am actually acquiring land. So my interest is land's fair value, and hence that is the benefit or the return that I am going to get out of it. A lot of companies, what they do is they have a SPV who acquire the land, get the NA clearance and everything from that particular entity. Once that is done, then they merge this entity or acquire that entity into this entity. Most of the major conglomerate companies where they have expansion plan on various their businesses, they do this way, so that this business never get hampered with any sort of land related issues, and as soon as they have a clear land title, they acquire that entity in its books of accounts, and that entity may be within the group or may not be within the group. Majorly they are never within the group, so that they get the benefit of fair valuation while doing the fair value acquisition accounting in the books of accounts of that land or that property. So this is what I can give you maximum example so far as variability of returns are concerned, right? Any question on that?
Suppose if there is a, you have all that is fine, but suppose there is a unit which you have which is in a country which prohibits someone to say that you are a part of this larger conglomerate, and it says no, my entity has to remain standalone. Suppose there is a law of some country which is there, which is a subsidiary of mine. Then in that case, what overrules it?
No, so is your example that the foreign entity law will never allow you to repatriate the fund or return?
They say that this entity, as far as it is concerned, it is governed by our local laws only. No one has any other right which is there for whatsoever reason. So in that case, it's a hypothetical, but it does happen when you are dealing with multiple countries.
I have never seen that. At least law doesn't do that way, because then it becomes if any country's law prohibit any other entity to attract the investor, then it's like it will happen that way. Not why then the other entity will invest into that entity.
I'm saying only for the purpose of consolidation. It does not prohibit it, but it says in that
Then it lose the assessment of a control in that case, that I don't have any return out of it, then for what I am holding that investments. Then the question of impairment also arises. That whatever investment I have made into that entity, whether it's worth of it or not today, because I am not going to get anything because the law does not allow me to do it or take it. Right? So the second question arises on the impairment testing. Okay, the next is important, the link between power and the variability of return. So we know that voting rights, non-voting rights, substantive rights, protective rights, by way of which I have a power. Okay, I know that by doing so, these are the benefits that I am going to get it. But what happens if I don't have both together? Then will I be able to still say that I have a control over it? The answer is no. So the link between these two is important, that I must have both together rather than individually, right? And the best example is the fund manager. So in the fund, whatever funds are there, generally there is a fund manager who has lot of power so far as taking various decisions of that fund money is concerned. It takes lot of decisions in terms of how much to invest, where to invest, when to take off, right? And his own fund is also involved into that fund, right? And his remuneration is also akin to how much he is going to earn the profit for the overall fund and other members, right? As well as the fixed remuneration also. So that becomes very important, that whether he is working in a capacity as a fund manager who just administers some of the powers which is limited given to him for the functioning and operations of the fund for the objective of earning maximum returns out of it, or he has the variability of return issue also. So he has power. But by doing so, how much variability of return is going to, cover out of it is a second test to be done. And that's the example what it talks about. In most of the cases, fund manager will not have the power, considering that his fixed or a variable return is still fixed to the extent of his, money is involved, let's say 40%, 50%, but other 50% or more than 50% money is like all of us money, right? In which case he is going to take various decisions for the fund in a limited way only. If he goes above and beyond of certain decisions, he has to go back to the members and go back to the board, and he will not directly take certain decisions, in which case he becomes an agent and not the principal, right? So by doing a principal versus agent relationship, I will be able to understand that whether I have a link between both power as well as the variability of return or not. If I am a principal, I will have a link established. If I am an agent, I will not have a link established, and hence I will be out of it, out of control. Are you with me? We want to read this example, verbo. I don't get response. No question. I have a right. I am the first one to take this session, and I am very happy and overwhelmed, and you won't. I got a goosebumps when I standed here. First time I was nervous actually. Those who are attending my sessions so many times, but today's I am a little different. But please ask questions. This is not a simple. I tell you. I would have done more than 200 companies assessment during the IND AS transition only, and every time when I read through the shareholders agreement, the assessment is totally different and challenging, because you just don't read the agreement and apply based on this principle. You also apply the practicality of the world, the business sense so far as those arrangements are concerned. And then you have to be very interrogative, asking questions on whether there are other arrangements also or not. Then only you will be able to get to a bottom of the answer. And as I said, it will be unilateral control. It will never be like a both will have, and both will say that we both have a control over it, and we both will consolidate as a subsidiary. This will never arise. In earlier time it was the case. There were two companies consolidating as a subsidiary of one entity because of 50.1, and then I have 3 directors. The other company is having 3 directors, and the one company is having 50.1% of the shareholding. So both enjoy consolidating it, which will now never be the case here. Absolutely.
People are looking at, are you an associate, how have you classified there, how is your pricing? So there is a new dimension which has got added. So in fact, classifying it as a control itself is a backbreaking exercise in a large company.
Absolutely. And all these related party transactions, even if it is a penny amount, are scanned and looked into by all the stakeholders, including the auditors. And the management has to be ready to prove that it's all are a arm's length transaction. Because from the Companies Act, from the SEBI LODR, from the perspective of transfer pricing rules, everywhere these all are scanned and you are questioned. And from the auditor standpoint also, our responsibility to make sure that those are being tested by us as well as an auditor. So very important aspects. Okay, so I think we are done with the control assessment, the definition part, where the most of the weightage is there. Now we can break for 10 minutes for the tea as well as the biological break, and then we will come back around 5. Okay, so we'll take 15 minutes, 5:25. Okay, because we have a lot to cover so far as the consolidation of procedures are concerned. Then we will go through associate accounting and the joint control, joint venture accounting as well. So thank you so much for all those who came back. Okay, so the second half of this session will go a little faster, because the major one was difficult in terms of the overall control assessment in terms of the principle and the concepts, but now we will talk about more of a procedure aspect. So this slide talks about the different standards, at what level or at what relationship level the standard will be applicable. So when you have a control, which we discussed already, then it's IND AS 110. When it's a joint arrangement, which we will talk about from the concept standpoint, that when the joint arrangement will have a joint control or a jointly controlled entity or an operation, then IND AS 111 as well as IND AS 28 will play a role. And then next is the associate, when you have a significant influence, where IND AS 28 is there for the equity pickup accounting. And one standard which is IND AS 27 for separate financial statement. It's just a 2-liner standard now, because these all standard are like came up or the got a birth from IND AS 27. So earlier IND AS 27 or IAS 27 from the IFRS standpoint was the main standard which lay down the principle of consolidation, associate, joint venture and all. And the way everything has evolved, the different transactions in the different economies evolved, they have carved out various concepts to different standard, and got the separate standard. And that's why now IND AS 27 or IS 27 is nothing but a remainder for only one line standard, that what will be the accounting of investment in the books of a parent when it invests into any entity of whether it's a subsidiary, associate or a joint venture. So that IND AS 27 is not written specifically here, but I just tell you that what will be the accounting treatment so far as the investment in the standalone financials of a parent company is concerned, how it is accounted for. So IND AS 27 gives a option, either you can account it for at a cost or you may go for a fair value. And if you go for a fair value, then every reporting period you have to do a fair valuation of those investment, which is the principle akin to what AS 13 we used to look at it under old GAAP, right. So you have a choice. If you have made an investment into subsidiary, associate or a joint venture, either you carry at a cost, okay, whatever the initial cost, then you will carry at a cost, or you may go for a fair value. If you go for a fair value, every year reporting period you have to do a fair valuation of that investment, okay. When is consolidation required? So I said it is when you say that I have a relationship of parent and a subsidiary. The relationship we know, the control assessment. So on the reporting date, if you still subsist that relationship, you will prepare a consolidated financial statement. Just like a standalone financial statement, you will have all the components so far as the consolidated financial statements are concerned. Your statement of profit and loss account, statement of balance sheet, the statement of changes in equity, cash flow statements, notes to accounts, schedules and all the other notes. Again you will follow schedule 3. So under schedule 3 there are 3 parts, part 1, part 2 and part 3 of the Companies Act, which govern the format in which your financial statements will be prepared. So it will be part 2 so far as IND AS is concerned, part 1 is for the IGAP financials and part 3 is for the NBFCs and the financial institutions, which is for the banks to look at it. So for all of us it will be more of a part 1 and a part 2 requirement so far as schedule 3 of the Companies Act is concerned. One of the important aspect on this slide is there is no exemption so far as consolidation is concerned. If you have a subsidiary, associate or joint venture and or you have to prepare consolidated financial statements. Now I take a practical scenario of a listed company having only one entity where they invested and it becomes an associate company, right. What happens that they end up preparing consolidated financial statements, and if they look standalone and consolidated financial statement total page by page, line by line, there will be only one difference is the investment, because it has invested into associate and it will be equity pickup and that is what is accounted for. The second side in the P&L there will be one line item, what is the profit picked up from that investment into the associate, and there will be one extra note that will come so far as its net assets is being considered so far as the disclosure is concerned. Now imagine a listed company who is following IND AS, okay, and who has to follow all the IND AS disclosures, and its financial statements is like running into 70 pages, has to prepare more 70-80 pages for its consolidated financial statement, which has only one associate, and it just has this difference between the consolidated financials and the standalone financials. This is practically happening and there is no exemption, right. So this is happening and this is how it is, the Companies Act is written. So even if you have a one subsidiary or associate or a joint venture, you will end up doing consolidated financial statements from the auditor standpoint also, from the company standpoint also, from ROC filing standpoint also, okay. The second is that there is no exemption for venture capital organization who day in day out invest into the companies, no exemption for mutual funds, unit trust and similar entities who day in day out invest into the entities, and subsidiaries with dissimilar activities. So earlier this kind of concepts were there where the entities are totally dissimilar in its business and the nature, and hence you are exempt from consolidation. There were few guidance available under some SICs which were given earlier. which are no more applicable. Even if one entity is having some business which has nothing to do with the subsidiary entity's business, still you have to consolidate and prepare a consolidated financial statement. At a group level, you may not make any sense from the overall economic entity standpoint so far as both the businesses are concerned, but that's how the standard is, and that makes a sense so far as the group as a one entity is concerned. When you say that how much is the total group's strength so far as financial performance of that entity is concerned. Okay, and then last one is that a subsidiary acquired exclusively with an intention to resell is not consolidated provided it meets the IND AS criteria of disposal group on acquisition. So this is one carve out given in the IND AS. Under IFRS it is not there. So if you have invested into an entity and with an intention to sell it off immediately or in near future, and if you establish that that okay, I have invested into an entity which becomes a subsidiary, but I have an intention to resell it immediately, okay, then you can exempt it from the consolidation if you follow the other standard of disposal of entities or group of assets of the company is concerned. Apart from that, there is no exemption except one exemption which is available in the next slide. So if an entity which is an intermediate entity, now when I say intermediate entity is, I am talking about this entity, on above there is a parent company, okay, and below this there are, let's say, 5-10 subsidiaries, okay. Now this entity I am talking about, this entity may be exempted if it applies this exemption from the accounting standard. So this entity has subsidiaries, okay, has taken approval from all the subsidiaries in an AGM that if this entity does not prepare consolidated financial statement, it is fine. So resolution is passed at AGM level. The parent company, ultimate parent company, is either listed or it is going to be listed, and its financial statements are prepared at a console level and it is publicly available, right? And this entity is never envisaged to go for public or for listing purpose, then this entity can take the exemption of not preparing consolidated financial statement by virtue of this exemption given under the standard. The same exemption is given under the Companies Act as well. Are you with me? You understood the exemption which is at an intermediate level and not at a main parent, ultimate parent entity level. The next is, it is a post or so long employment benefit plan to which IND AS 19 employee benefit applies. So here there is no exemption so far as those trusts are concerned. If you have created any trust for the long term employment benefit plan, gratuity trust and all, if those are controlled by you, then you have to end up consolidating, except there is an exemption given under IND AS 19 for special trust for the gratuity, but PF trust you end up accounting as a consolidated. Any other trust, CSR trust, education trust, or any purpose of trust which are created by the entity, you will have to consolidate, and that's where the question arises, whether I have a LLP or a partnership firm under me as an entity, whether I will consolidate or not. Yes, you will consolidate, right? So procedure for consolidation, these are the 7 steps through which the consolidation procedure will happen. The first one is the identify the acquirer. This will happen on the day 1 when the acquisition of the entity is done. Again, that will be governed by IND AS 103 business combination. The second is identify the date of acquisition, because it is important that what is the date of acquisition. Now let me give you an example. I said that I will cover this. So let's say today 2 businessmen sitting across the table, one transfer the consideration, right, and the other transfer the equity shares. Now equity share will be transferred by way of law, right, legally, when the actual shares being transferred and the ROC filing will happen, right. It may happen 2 days later or 5 days later. Then the question arises, which is the date of acquisition. Now in this situation, whether 2 days before or 2 days after may not make much difference so far as the fair valuation of net assets are concerned. But what if they have to undergo a legal approvals like NCLT scheme approved schemes, right. So those transactions where they route through a NCLT approved scheme where they have to take all the clearances from all the departments, they have to take the stakeholders clearances, then they have to submit the the scheme which is certified by the practicing chartered accountant, and then the NCLT pass an order. Now it takes fairly time of 6 months, 10 months by which the NCLT will pass an order, and then they will say that okay, this merger or this acquisition is approved and you can take it up. Now what happens? What is the date of acquisition? In this scheme, what is written is X date valuation is considered, X date shares are considered, X date based on that, this is how the arrangement will happen. This is how the purchase consideration will transfer from transferee company to the transferor company to the transferee company, right? And this is the accounting treatment will be done on the date of appointment. Now that appointment date is the date on which that fair valuation has been considered and entire transaction has been done. But effective date is today, after 9 months, when NCLT passes the order that okay, you can do so, right? So now here, what will be the acquisition date is a question mark, and when I will account that acquisition in my books of account is a question mark. So under IFRS regime, international standard, there is no point but to say that legally if it is enforceable today, then today is the date on which I will get the right to the shares of that entity and have a right to control you by way of voting rights, and hence today becomes my effective date. That means the NCLT date, orders date becomes the effective date, and I need to do accounting being that becomes my acquisition date. That is under IFRS, but under IND AS there is a carve out. In this example, my acquisition date becomes the appointment date, which is written in this scheme, which may be 9 months earlier, right? Why? Because NCLT is a law. The law prevails over accounting standard. There is a specific guidance by the ICAI, and because of that, the appointment date becomes the effective date for accounting purpose. And in the financial statement notes to accounts, we have to categorically say that the appointment date is the 9 months older date, and the scheme is effective from the date when the NCLT gives the order date, and then ROC filing also happens in parallel, INC 28, and basis my scheme is effective. Now that is the scenario so far as the ARC situation is concerned, which is different from IFRS standpoint. And that's why the appointment date fair valuation will play a role for accounting purpose and not today's value, which will be different from the appointment date's valuation. Now by that, this is one example of carve out, right, between IFRS and IND AS. There are many such, considering the Indian economy and scenario, there are many such carve outs. Now out of blue, any client comes and say that I am already IND AS compliant and I want to go and list on a London Stock Exchange, right? And I am already IND AS, I don't have to do anything. I can straight away take my 3 years or 5 years financials and I can go and file there. Is it a correct statement? Can they do so? Yes or no? No. The reason being that IND AS is so much different than IFRS because of these all carve outs that nobody can say that I am 100% IFRS compliant. Even the IND AS 101 itself, which is a day one transition standard, is having much more carve out than IFRS 1 when any entity moves from their local GAAP to IFRS. And that's where the carve outs arisen, and there are various other carve outs so far as all these standards are concerned when you get into the life of IND AS as an entity, right? So that is a point on the identify the date of acquisition. This all step 1 and step 2 are of 103. I just in nutshell covered. Otherwise, identification of acquirer is also very important. There are transactions where happen that company A and company B becomes the company who is a small company, and A is a big company in terms of net worth. B company is a loss making company. A company merges in B company, A company loses its existence, B company still remain, right? And the consideration will be swapped between the shareholders. Now who is the acquirer? Whether B will be acquirer or company A will be acquirer. You are saying A has gone. So this type of transactions also happen. In this situation, it may be possible that company A becomes an acquirer and not company B, just by way of doing the entire transaction, where it will be subsumed by company B, but the real transaction happens from where the purchase consideration has been transferred to the erstwhile shareholder. That becomes a main one, and then it's merely the change in the name, or company B remains the same, right? And from that standpoint, the fair valuation will play a role, that what will be my purchase consideration fair value and what will be my net assets at a fair valuation standpoint. So step 1, step 2, nutshell, I have just explained 103. We are not getting into 103 right now. Step 3 onwards is my IND AS 110, which I have prepared today. Calculation of purchase consideration. Again, 103 talks about purchase consideration, how to calculate it. It is always the date of transaction or the acquisition date. What is the fair valuation of the purchase consideration which is flowing from one entity to the another entity. Calculate the identifiable net assets. So all the assets and the liabilities which are taken over by the entity, whatever value, you have to fair value it. That is first thing. So those are identified assets and liabilities. What about the assets and liabilities which are not there in the financial statements of that entity? Are called the identifiable assets and liabilities. For an example, I give you an example of brand acquisition, right? Now nowhere brand is valued in any books of accounts of that entity, because it's a self-generated brand. But I am paying you more. Today, I am paying you more, not only the worth of your business, of the net assets, but more than that, which becomes my goodwill ultimately. So I am saying that out of that amount which I have paid more, there is something which is called the intangible asset, which is a brand which I am identifying. So that's why it says that you have to identify what all assets and the liabilities which are not present in the balance sheet on the date of acquisition, you have to identify and account for at the time of business acquisition accounting. The second example is contingent liability. Generally, contingent liability will remain contingent to the extent that it will not consider the form and the flavor of provision. But at the time of acquisition, it may be possible that you want to bring that into the books of accounts, considering the fair assessment that I am paying you more or paying you less, because I am foreseeing that this will come on me after acquisition. And rather than keeping it as a contingent liability, I will put it as a provision or a liability in my books while doing the net asset accounting, right? So identifiable those liabilities and those assets in the books of accounts. Once that is done, then you will calculate the non-controlling interest and the goodwill. Both will go hand in hand, and then you will do the consolidation procedure at the year end. Any question on this? Okay. This slide talks about consolidation adjustments and the procedures. Very simple so far as if one needs to explain. A little complex when one needs to put down in the Excel, or while we used to do those sums before 17-18 years when I was trying to make the debit and credit and all those T balance sheet and all. So major adjustment is a goodwill, NCI and consolidated retained earning. Goodwill is the difference between what is paid and what is received, right? If I have paid more than what I have received is my goodwill, and vice versa will give me a capital reserve situation. The term it calls is a bargain purchase gain. Okay. Now that term is there under IFRS, under IND AS it is still a capital reserve. Okay. So goodwill calculation, NCI is nothing but your minority interest. Non-controlling interest is nothing but a minority interest. The term is different in our IND AS and the IGAP. So that is required to be calculated. The second is intercompany adjustments. So parent and subsidiary, parent has sold goods to subsidiary or vice versa. So you have to knock off or eliminate the purchase and the sale transaction at the console level, right? And whatever receivable payable is there in this respective book is also required to be eliminated. So it's more of a balance elimination and a transaction elimination. Are you with me? And the third is a profit elimination. So by virtue of this transaction, if any books of accounts the stock lies as an inventory, that means that is element of profit which is unrealized, which is sitting in the books of the company in which the inventory lies, and that is also required to be eliminated at the year end as a consolidated adjustments, right? And the fourth is any non-current asset type of transaction has been occurred between two entities. Now, what is non-current assets transaction? Is any fixed asset, property, plant, equipment is being sold between two entities. Then you have to eliminate that transaction as well. We will go through the example for that. So, are you with me? Consolidated adjustments. So, one is a day one adjustment so far as goodwill is concerned. The second is NCI will, every year will occur, and all the eliminations that you need to do at the year end. And that's how you will prepare the consolidated financial statements. So, goodwill calculation, this is the formula given under IND AS. So, what is the purchase consideration transfer? Again, the fair value of the transfer of, either you pay cash or you give the equity shares, right, or you give both the combination. What is the fair value of that consideration which is transferred from transferee to the transferor, right, or acquiree to the acquirer to the acquiree. Then you have to add NCI portion. Now, there are two methods available to calculate the non-controlling interest. So, let us say I have invested 80% into entity A, right, and I have paid 1000 rupees. So, 1000 it is a fair value, and 1000 becomes my first purchase consideration transfer for 80%. Then 20% I will add here as a NCI. So, 20% of, if I work back 1000, then 20% work back. So, 1000 into 20 divided by 80, what that amount will be added here as an NCI portion. That means the entire value of that entity is captured here as first two line items. Then I will add acquisition date fair value of previously held equity interest. Now, this comes only when I already held certain investment into that entity. In my case, it is not the case, so it will be 0. If, let us say for example 5% I was already holding, right, and it was a normal investment, and on top of that I have invested further 80%. So, that 5% investment I will add here at the acquisition date value, and less identifiable net assets acquired. So, now I will have the entire net assets of that entity of company B, and that I will reduce at a fair value, I will reduce it here. Whatever remaining I will get is a goodwill amount, and this is the day one goodwill, it will not change. The day one goodwill will not change. Day one goodwill is once calculated, it will remain. Okay. The one question is whether goodwill is amortizable or not. Can I amortize the goodwill? If yes, what is the treatment? If no, what is the treatment, and how the income tax looks into it? Goodwill is subject to impairment. Okay. All unanimously answering the same? Sure, lock कर दिया जाए. Okay. Apart from NCLT approved schemes, still I have seen few schemes just before weeks time. The NCLT still gave approval for amortization of goodwill, but that was under IGAP. So I can still give a benefit of doubt under IGAP that this is still possible, where NCLT is okay with amortization of goodwill over 5 years. And then from the income tax standpoint, I am not an expert, but you will have to take a cognizance of other things that it is actually not allowable, considering it's a more of a adjustment at a book entry level. But having said that, under IND AS regime, IFRS regime, goodwill is always tested for impairment at each reporting date, and it will never be amortized over a future period. The second most important is that whether at a first stage I should have a goodwill or not in my books of accounts is the first question. By doing this formula, can anyone understand my view here that by doing everything at a fair value, will I reach to a level where there will be goodwill? Just open your mind and think, there is nothing free in this world, right? आज ये सेशन लूँगा तो खाना मिलेगा मुझे. There is no free lunches in this world, right? आज 2 businessmen बैठे हैं सामने सामने. Why I should pay you more? I will pay you what I am getting, right? Then why there should be a situation of goodwill? तो तो आना चाहिए गुडविल या नहीं आना चाहिए? If you think from all the practical economic way and rational business sense point, whether there will be a goodwill or not. Brand value, okay. Perceived value.
All asset cannot be accounted in the balance sheet, like employee or training employee you have, or technology you have, which is not in the balance sheet. You will have to provide the customer database.
License you said, okay. Then customer data you said. So all of you are bang on 100% right, and that's why they say that identifiable asset and liability to be captured. Now if you follow that, first and foremost, my transaction is as an arm's length transaction at a fair value. I will pay you what is valued and you will receive what is valued. That is first thing. The second is, if I get the goodwill, that means all license, brand, perceived value, employees, whatever I have created so far are identifiable asset in your books of accounts, and some liabilities. If you allocate the value to that at a fair value, after that, do you see there should be something which still remain in the books as a goodwill? The answer would be, no. Right? To be fair and rational, it will be no answer. And that's why the standard says that, whatever is then remaining only becomes a goodwill, which is really the amount which you have paid more than what you are getting. Otherwise, still that point in time, you please do a fair assessment and allocation of identifiable asset and liability and account it for in the books of accounts. So whenever you think, come across any transaction, make sure that you pay attention to that goodwill and see that whether there are certain line items which are not considered in accounting or not. क्यों वो दो बंदे बैठ के ऐसा ट्रांजेक्शन क्यों करेंगे? Very simple, right? Why should I pay you more if it is not worth of it, right? So this all becomes, and then it becomes like a goodwill. The second aspect is impairment of goodwill testing. So why it is not amortized, the reason is this only. The other identifiable asset, you will go on depreciating it and you will get the benefit whatever is required. उसके ऊपर आपने जो दिया है, that is tested, because whether you will continue with the same business with same, whatever you have paid more, the value will remain as it is or not in future. It may increase, it may reduce. If it reduce, then you have to impair it. You cannot get the benefit out of it. That's the second, concept so far as or rational or a logic behind this. Okay. The next point is the cost of acquisition. So standard is very clear, saying that any cost which you incur out of the business acquisition are P&L. Okay, it will be directly debited to P&L. And fair amount of transaction costs are there generally. Your legal cost, accountant cost, audit cost, fair valuation, report cost, and lot of costs are there so far as the transaction accounting is concerned. Only share issue expenses, and to limit share issue expenses in our context is like ROC filing fees or increase in the authorized share capital related fees, stamp duties, etc. will eligible to be set off against equity, which is allowed under IND AS 32 financial instrument as well as under the Companies Act. All other cost of transaction cost in nature, acquisition cost in nature will be P&L. So client will come and tell you that नहीं यार इसको amortize करते हैं 5 साल के लिए, इतना बड़ा expenditure है वगैरह. Be sure that we are not taking any such kind of aggressive call so far as transaction costs are concerned. Any cost directly associated with the acquisition of this subsidiary expense to P&L. There are two other concepts called deferred consideration and contingent consideration. So deferred consideration is what is, let's say today I am paying you X amount and after 12 months I will pay you Y amount, but today I am acquiring you 80%. So that's a Y amount which I am going to acquire pay you after 12 months is deferred for 12 months. Now I am going to pay you X amount, Y amount after 12 months is required to be fair valued, present value today, fair value means present value today, and account for so far as my purchase consideration is concerned, and that's why it's called the deferred consideration. There are a lot of transactions which happen this way. Why? The reason is that sometimes I acquire you, and I will also make sure that the business is continued by those people who have actually built that business. For next 3 years or 5 years, there is a lock-in period or a non-compete business terms are there in the shareholders agreement, and I will also agree with you that you have to maintain some profitability, you have to maintain the turnover, or you have to achieve certain target. If you do so, then I will pay you this much additional consideration, and that's why it becomes a deferred as well as contingent consideration on future events that happen. What standard says that if you have certain type of clauses in your acquisition transaction, you have to built in purchase consideration today by doing it fair valuation, and also assigning the probability so far as the contingent consideration is concerned, and accordingly you value your book goodwill. Yes, based on the facts you will assign probability. You will see the past experience, past performances, and the future probability of how much they are going to do it. It depends on the condition which is there. Any question on this? Okay, so this is one example of deferred consideration. So I'm not going through it. It just says that this 10,80,000 on the third line is a deferred consideration. What they have done is in 1 year's time they will pay it. So by 8% of cost of capital they have present value it and considered as a part of purchase consideration, which is 31 lakh. So 21 lakh upfront today payment, and 10 lakh is a present value of 10,80,000 which they are going to pay it. It's a simple maths right now. Share exchange. So if you are exchanging shares as a purchase consideration, then you will do the fair valuation and the number of equity shares to be accounted for in your books of accounts. So again I am skipping this, it's normal example. Now this is important, non-controlling interest or minority interest. So first is NCI will be accounted at the portion is that minority interest, that percentage which will be applied to the net assets of the company, which is the profits. So far as the profit of the company is concerned, and net assets on the day one, right? The second is that it will be kind of a liability, but it will be disclosed and presented after the other equity as a separate line item called non-controlling interest. And in comprehensive income, so statement of profit and loss or a statement of comprehensive income, it will be separately disclosed after the net profit, which is attributable to NCI and attributable to the shareholders of the company. So that is the requirement so far as NCI is concerned. Now there are two methods available so far as NCI measurement is concerned, which is not there under IGAP. So under IND AS, under IFRS, there are two methods. First is their proportionate interest in fair value of identifiable net assets, and the second is fair value. Now what do I mean by that? Is this. So while calculating the goodwill, you have to have a NCI into the place, right? We have gone through this formula first. This one, the second line item is NCI, which I want to put it and add to my purchase consideration. That second line, how to calculate, has two methods. Okay, the same formula is there in this slide. So option 1, NCI measured at a fair value, and the second is NCI measured at a proportionate share in net assets method. So what is the difference is, let's say I am acquiring an entity which has a fair market value of that entity per share value, okay, and I am acquiring 80%, so I know the 20% shares, 20% number of shares multiply with its fair value or market value. That is what is mentioned as a NCI measured at a fair value. And the second method is, I don't have a market value available, but I will do the fair valuation of the business. Whatever net assets are there at fair value, I have done it. That net assets multiply with 20%, I will take it in my option 2 accounting. And that's why it say that proportionate share in the net assets method. Both the methods are allowable. If you choose any one of it or elect any one of it, you have to consistently follow it. You can follow, these methods selectively for transaction by transaction as well as. So, for an example, one entity I have acquired and I will do option 1, the second entity I can go for option 2. The related disclosure is required to be given in the financial statements. Okay. So, let us go to the example. So, this is one example. Leela Tech acquired 60% of new Leela, cash consideration of 1000. So, my purchase consideration is 1000, the first line. This business combination occurs after the end of the reporting period. The fair value of new Leela's net identifiable asset is 1500. Okay. This is 1500. And the second information is the value of new Leela's NCI 650. So, they have given the fair value of the shares of NCI only, they have given directly. They could have given the fair value of the share at an entity level also, but then multiply with 40% would have been the same amount. So, in the option 1 at a fair value, they straightway take 650 added to the purchase consideration less the total fair value of the identifiable assets and liabilities. So, first is a 150 goodwill. The option 2, they put the 900, which is 1500 net assets value into 40% of NCI portion. So, it is a 900 to NCI, reduce total fair value of the net assets acquired, the remaining is a goodwill at a 400. Now, these both are mutually exclusive, you do not have to relate to both of them, either of the option will be available to follow. Okay. So, you may not just compare it that what happens if I have option 2 value 150, record at 150 or at 400 in the same example. This practically does not arise. Either of the method you will be comfortable doing it based on the data and information available, right. But logically if you see in the second method, yeah, it will be 100 and it will be 150, perfect, okay. There is no intention because it all depends on what type of data and information you are available with. Both method can be available. See, if you are acquiring an entity which has a fair market value at a share price, you can take it anyways. While doing the acquisition accounting, you do the net assets valuation, so you can take that value as well.
गुडविल अगर हम दोनों जो भी कंपनी होगा वो दोनों मेथड से चेक करेगा तो इससे इन्फ्लेट नहीं हो पाएगा.
हो, हाँ, yeah, it will be. It will be, but both the options are available since it is allowed. The rationale I said is in one method you are attributing the goodwill of a NCI also in your books. That is an inflated goodwill to some extent.
So while selecting the user of the option, there is no guidance available for many of these.
It's an election given to the user. It is subjective. In fact, it is subjective from the perspective of one time you are saying. I am saying I have 10 transactions and on all 10 transactions I am doing differently. The standard is okay with it. Yeah, so impairment testing we spoke of, that goodwill will always be subject to impairment and you will apply IND AS 36 for the impairment testing purpose. And have all the disclosures in place, prepare all 5 years financials, data, do the discount and see that what is the carrying value and the recoverable value, compare it. If it is less, then you will impair it. If it is more, you will not impair it. I spoke of intercompany balances. So, this is pretty straightforward so far as intercompany balance eliminations are concerned. Only one point I want to cover here from the perspective of how it becomes complex in scenario where you have a foreign subsidiary. So, an Indian entity has sold to a foreign subsidiary. So, in the Indian entity's books of accounts, if the invoicing happens in INR, it will record receivable in INR. The other entity will record in, let's say, USD, okay, and it will have a payable in USD. If Indian entity, so there at the time of consolidation you will restate the numbers of receivable and payable. Now here the INR is absolute amount, that USD amount, the day one USD is converted from INR to USD and then year end also it is converted with some different average, year end rate of INR USD, and then it is compared. There will be a little difference so far as FX difference is concerned. What will happen with this FX difference is the question, where I will account it for, whether it will be CTR, foreign currency translation reserve under IND AS 21, or it will be my FX loss or a gain straightway to PNL. It will be PNL. How many of you say PNL? બાકી બધા FCTR ના આ FCTR માટે પણ હાથ ઊંચો કરો અને બાકી બધા સુવે છે. So this is important, okay? From the again concepts, I go back to concepts. See, when India has raised an invoice in INR, it doesn't have any exposure, right? The exposure of FX is in the hands of US entity, right? So in the standalone books of US entity, while recording this transaction and while reporting that at the year end, they would have already captured the FX difference at a standalone level, which would have already gone into PNL. They would have restated their INR payable into USD at the year end, and whatever is the FX portion, they would have already debited to PNL, right? Are you with me? Now this second difference arises merely because of the translating the USD trial balance into INR, and hence it will take a form of FCTR, right? If this would have been a different situation where India has raised USD invoice, then I would have already captured the FX difference in my books of accounts by restating it into USD to INR at the year end. तो वो PNL में चला गया. Then again it will be a translation reserve which will go to FCTR. Okay. Now this is simple example. Now what happens if you are routing it through 2-3 layers? India से Middle East गया, Middle East से US गया, US से Africa गया, and you have 2 to 3 currencies, and it becomes very difficult that how much FX exposure at entity level and a country level has been borne, and what is the FCTR it will come. दूसरा issue आता है at a console level, what all rates you are considering at the year end. If your cross rates are not matching with the direct rate, then you will have further more differences arisen because of just the rates which you are capturing, right? And that it becomes a very complex to identify how much to go FCTR and how much will be PNL. Practically, I have dealt with this in one of the listed company, and for last so many years they were, capturing this value in a PNL, and every time, every quarter, it was difficult for the CFO to explain that ये amount आ कहाँ से रहा है, कैसे इसको explain करूँ. Every time he used to give different stories and चल जाता था. But then, we did a special consolidation engagement starting from 10 years before when they really started acquiring those entities, और वहाँ से लेके आज दिन तक देखा कि issue क्या आ रहा है and how much is attributable to FCTR and how much is PNL. The answer was astonishing to them, saying that 90% of the amount should be FCTR and only 10% was actually attributable to PNL. And because it's like a quarterly and every year, it was go on building and it was go on, putting through reserves also. Now, for so many cumulative years, you see, some entry will be, required for rectification from removing from reserves to FCTR, right? And some will remain as a part of FCTR, which was part of a PNL. The more issues arises are this, which I said that the cross rates were taken differently. Well, they were taking different rates. It was not, taken सेम होने चाहिए. वो सेम लेते हैं तो डिफरेंसेस कम आते हैं. वो सेम नहीं होते हैं. मैंने कोई एक्स रेट लिया, उन्होंने कोई वाई जगह से लिया, एक्सी से लिया, और मैंने आरबीआई का रेट लिया. मैंने एक्सपोर्ट्स का रेट लिया, उन्होंने एसबीआई का रेट लिया. सेम डे पे सेम रेट सेम ट्रांजेक्शन के लिए डिफरेंट होगा. वो जो डिफरेंस अराइजन होगा ना, वो टावर कट हो रहा है, इसके लिए उसके लिए ये चीज़ हो रही है. This is the reason for which this type of differences arises, which required a treatment accordingly. Now coming back to intercompany balances and transaction, one of the important is unrealized profit. So in the books in which those inventory is lying, so far as purchase and sales are concerned, that entity's unrealized profit is required to be eliminated from the inventory and the from the sales side, COGS side, and that becomes one of the critical elimination entry from the perspective of subsidiary and parent company. Again, there are two ways of transaction. One is the downward transaction and an upward transaction. The guidance is available based on which the unrealized profit is required to be eliminated from either of the entity, but at a console level it is required to be eliminated. The next is non-current asset transfer, is a transfer of fixed asset. Let's say one vehicle or a car has been transferred from parent to subsidiary or vice versa, maybe with profit, without profit. If it is a with profit, so carrying value जो WDV है उसके ऊपर कुछ profit के साथ transfer किया for an example, तो ultimately at a group level क्या हो रहा है, 1000 rupees value has been transferred at 1200 rupees for an example. So 200 रुपये का unrealized profit हुआ, right? So वो 200 को eliminate करना है. अभी ये entity ने 1200 पे depreciate किया हुआ है, तो 200 पे जो depreciation आएगा for the time period उसको भी eliminate करना है. Are you with me? Transfer of asset being a property plant equipment from parent to subsidiary. Ultimately क्या हो रहा है, at a group level asset तो कहीं गया नहीं है, वो तो carrying value जो 1000 थी वो depreciate होके 900 होनी चाहिए, वही होनी चाहिए, right? बट अभी 1200 पे उसने ट्रांसफ़र किया और उसको depreciate करके वो 1100 पे लाया, that's why वो difference हुआ, change होना तो 900 चाहिए था. तो ultimately we are removing that profit element and depreciation on that profit element, provided both are having the same useful life. अगर useful life change होगी subsidiary entity में तो उसको भी align करके वो eliminate करना चाहिए. Simple way, ऐसा कोई transaction है उसको reverse कर दो console level पे, पूरा reverse मार दो, entry transfer की entry पूरी reverse मार दो और depreciation की भी entry reverse मार दो और जो original था वो as it is लाके depreciate करो, you will be home. It's as simple as that. हाँ, so in this case the original sales and purchase will be eliminated. In the books of accounts the inventory will take a form of your capital asset and you will depreciate it. So at an group level, if it is required to be capital asset, the way it is used, it will continue. So the intention is to consider that as an asset, as a property plant equipment. At a cost, it will be capitalized and it will be depreciated over a period of life, and the profit will be eliminated to that extent. Day one. Yes. No, you will remove the profit element only. Sale will still remain because you are having the sale in the books of the subsidiary, where you are having the property plant equipment capitalized in the books of the parent. When it comes to the console level, it will still remain as a property plant equipment because you are using it as a PP, as a fixed asset. See what will happen, I tell you. Subsidiary and the parent, right, becomes one entity. Now think that this asset has been constructed, inventory has been constructed by subsidiary, this asset is constructed and capitalized for the use of the business. What will be your accounting? You would have capitalized whatever total costs are there and you will use it for the business purpose and depreciate it over a period of time. So what remains is eliminated is a profit element on a day one, right? अगर वो एंटिटी में मैंने कंस्ट्रक्ट किया होता, ये बिल्डिंग को कंस्ट्रक्ट किया होता फॉर ऑफिस पर्पस, तो जो भी कॉस्ट होता वो मैं कैपिटलाइज करता एज अ प्रॉपर्टी प्लांट इक्विपमेंट, उसको डेप्रिशिएट करता. अभी उसको मैंने सब्सिडरी के थ्रू किया है और उसको फिर यहाँ पे ट्रांसफ़र किया, तो मुझे क्या एलिमिनेट करना चाहिए? प्रॉफिट एलिमिनेट का एलिमेंट इसमें से निकाल देना चाहिए। बाकी कॉस्ट तो एज ए ग्रुप लेवल पे मैंने इंकर तो किया है, एंड फ्रॉम द अकाउंटिंग प्रिंसिपल इंड एस 16 स्टैंड पॉइंट आई शुड हैव कैपिटलाइज इट at a cost and depreciate it over a period, and that's the reason the net impact will be eliminating the profit element, right? So that at a group level this asset is capitalized and depreciated over a period. This becomes a permanent adjustments for them every time at a console level. No, I am saying that, so if you remove sales and you remove the purchase also as a fixed asset and then capitalize the asset at a cost, you will reach to a same answer, right? Okay, any question on this? Transfer of non-current assets? Clear? प्रैक्टिकली बहुत डिफिकल्ट होता है ये करना, जीएसटी का भी एलिमेंट आएगा इसमें, वो तो सोचा ही नहीं किसी ने। मुझे आंसर नहीं पता है, मुझे अकाउंटिंग ट्रीटमेंट पता है। Okay, this is a statement of changes in equity. I'll skip it. Dividend also I'll skip it. Normal transaction. This is what is there, separate financial statements, Ind AS 27. I just narrated that separate financial statements, the investment will be recorded or accounted for at a cost or fair value, whichever is this you are electing for. If it is fair value, every year the reporting period it is required to be fair valued. You cannot go back then at a cost. Disclosure requirement I am skipping right now. Differences I have covered more or less when I touch upon specific concepts, so I don't want to reiterate again here, but if anything I am missing, I am just looking at it. Yeah, so under Ind AS it is still a capital reserve and it will be part of the equity, other equity as a separate line item in case of the bargain purchase gain, or it is a negative goodwill when you say. Whereas under IFRS it will be in P&L. The accounting is in P&L. Are you with me? Big difference. So if you are acquiring net assets at 1000 and you are paying 800 rupees. So 200 is your gain, it will be P&L as an income or as a benefit, as a bargain purchase gain in IFRS. But under Ind AS you will credit as a capital reserve under other equity.
So what's the rationale behind IFRS?
See, IFRS rationale is actually rational and a logic. Ind AS is not a logical. Okay. That's why I gave you that example of there are no free lunches in the world, right? Where I give the entire story of if there is a fair transaction, then there will not be any goodwill situation. If that is the case, then there will not be any gain situation also, right? Still there is a gain, then it has to be your day one gain. Why it is a reserve? You are actually benefiting from that transaction. That's why it's your actual gain, and you have bargained the transaction in a way that you gained out of it after doing all the identifiable asset liability situation. That's why it should be P&L. Under Ind AS, there is no logic. Why? Because we have seen, we are habitual to credit it as a capital reserve and continue that way. At the era of Ind AS transition, there were so many NCLT schemes which were already pursued at that time, which was talking about capital reserve separately credited, and hence this is specific carve out given under Ind AS 101 as well as ITFG, that if any capital reserve is there, it will remain as it is, and you will not transfer it to P&L for previous business combination transaction, and you may not revisit it. The same concept is given so far as Ind AS 110 is concerned, and it is continued.
If I have a subsidiary which is incurring loss and even the reserve is negative, so whether I need to recognize an NCI for that or not?
It would be. If it is negative, NCI is also getting into negative amount. So in that case, it will be 0 NCI. You will show it as a notes to accounts, whatever is the remaining amount, and then it will start accruing the profits. You will start adjusting it, and then accrue it till it becomes 0, and then start building up the NCI in future. But the biggest question arises here is at a standalone level, you will have to impair it, the investment, if it is loss making entity and all. So those issues will also arise on that, and going concern will also arise, which auditor will not agree with it. Okay, so consolidation is done. One concept I think I am missing. You should have, you should have reminded me of common control transaction, right? Okay, so what is common control transaction? Anyone can try? Control we know. Now what is common control? Huh? Not really. Anyone?
The directors are same in both the entities.
No. Common control is not like directors are same. It's still a relationship you will try to build between both of them. So what is common control transaction? Company A is there, okay, and it has 10 subsidiaries. Let's say wholly owned subsidiaries, all 10. And what is doing is 2 subsidiaries is merging together. Okay. Now what will happen? The shares of this entity, the net assets of this entity which is merged with the other entity will be swapped with the original company A only. Now out of 10, now it becomes 9 companies. These net assets of both the companies will be added together, right? The original shareholder is still remain original. So before and after, it is same control. Before that and after that, it is controlled by the same entity or same group of people, same person, same trust, same HUF, right? Then it is a common control transaction. Now what IND AS 110 is saying, so this is a big difference between IFRS and IND AS 110. IFRS standard 10 doesn't give any concept or discussion on the common control transaction, where IND AS 110 Appendix C has a detailed guidance on common control transaction, where your control remains as it is before and after, then it is called a common control transaction, and you will do pooling of interest method accounting. So AS 14 में हमने pooling of interest method देखा है. So everything will be at book value. Your all the net assets acquired it as a book value. Whatever you transfer is also at a book value, which is equity. There will not be any situation of goodwill and capital reserve in this situation. And if there is anything, you will account it at a book value only. In this situation, if there is any capital reserve arisen, it will take a flavor of capital reserve only, and you will show it as a separately in the financial statement. This is what the guidance is given under a IND AS 103, IND AS 110 Appendix C, common control transaction accounting. Why? Now you will ask the question why. So here in India, as I said, NCLT schemes, this type of schemes are very, very pervasive, and these are nothing but actually a business structuring in a way. So they are structuring their entities in a way within the group, right? Now this is a simple example which I gave you. Now if it is a within same group, it is more of a structuring, then why you inflate your amount of assets, inflate amount of liabilities and do the goodwill and all? Doesn't make sense, right? So that's the reason in common control transaction, it is at everything at a book value, pooling of interest method, and you are not allowed to do fair valuation. Otherwise everyone will start doing fair valuation within the group like this and inflate their net assets at a group level. No, can you elaborate your example? So you have a fellow subsidiary, right? Company A is there. This is one entity, and there is a fellow subsidiary B. C is there, A and B is there. 80%, 80%. No, so if they are not related for, they are fellow subsidiaries or a fellow associate or a fellow joint venture, you will prepare these books of accounts, you will not consolidate these into it because there is no direct link between both these entities. It's all a common control. तो यहाँ पे वो control जहाँ पे common है ऊपर, वहाँ पे consolidate A and B होगा by any way, but A के साथ B नहीं होगा. They are separate only. नहीं करेगा ना, A और B will not consider because they are fellow subsidiaries. They are in parallel. For what? How will you apply the concept of control here? How A will control B? हाँ वो करेगा, ये दोनों के बीच में कुछ नहीं है, सिर्फ डिस्क्लोजर रहेगा आरपीटी ट्रांजैक्शन में. दे आर फेलो सब्सिडरीज and by way of a common holding, ultimate holding, they are related to each other as a fellow subsidiary, right? And if there are any transactions between both of them at this console level, it will be eliminated, but at entity A level and entity B level, they are just a relationship which they will show. Ha. No. Okay. So now we will talk about associate and joint venture. So associate is very simple. Where there is no control and there is joint control, then it will be a significant influence. Significant influence is nothing but you will be able to just influence in the board of directors meeting and play your role to influence certain transactions which are important for you. So that's why it is called an influence, significant influence as an associate. How you can do so is you have a right to participate in the business of the company, right to vote, maybe protective rights in terms of some of the transactions you are involved and some of them are not involved. You have somewhere around 20 or 20% around in equity stake into the company. You are a board of directors, one of the board of directors or one of the key KMP of the company with certain other aspects, then you become you have a significant influence on that entity. If these are the indicators, then it is an associate of your company. And you will do equity pickup accounting. Now what is equity pickup accounting is very simple. Let's say I have invested 21% into that entity and I have one board of directors in that company. So I will take 21% of its net profit and I will add to my investment. Whatever cost of investments carrying value in my books of accounts, I will just add it. So एक entry P&L में जाएगी जो profits and share from the associate आएगा और दूसरा इन्वेस्टमेंट में डेबिट होगा, राइट? एंड दिस एंटायर स्पेसिफिक नोट विल बी गिवन एज अ डिस्क्लोजर इंक्लूडिंग द व्हाट आर द नेट एसेट्स ऑफ दैट एसोसिएट विच आई एम डूइंग इट एंड व्हाट इज द रिलेशनशिप एट विच आई एम होल्डिंग दैट एज एन एसोसिएट. सो इट्स वेरी सिंपल. If you don't have a joint control, then you will have associate relationship, significant influence, and that's where the relationship assessment is important. When even if at a 20%, you may say that I don't have a significant influence. If you don't have a board representation, which is least likely because at 20% generally you get a board representation, right? And that's why you may influence but may not control. Are you with me? So the example which I gave you for PSU company, this becomes critical for them. That even if I have a board representation, even if I am a 20, and I have made an investment because the government of Gujarat circular has asked me to do it just to facilitate that funding to that entity, and the board of directors is so much discretionary, discreetly, controlled by the independent directors, I may not have even influence. And from my past practice, my director has not played much role so far as the the relevant activities of that entities are concerned. In which case, technically, you can take a call that I still do not have any significant influence and I should not consolidate it. So that is one extreme end which I have actually experienced. The second is more or less at 20%, you still get to an answer of associate as a significant influence relationship. Are you with me? The investment carrying value will be added with the equity pickup of profit with whatever share you are having. You go on crediting it and debiting it in an investment. Let's say company that is making a losses, so you will have a negative amount which is reduced from your investment. You will reduce till it becomes 0, and then it will be notes to accounts where you will disclose that I am still having a negative losses. In future, once that entity start incurring profits, you will start accruing, I mean setting off those losses, accumulated losses of your portion to those profits which you are attributing, and then one day it will again become 0, and then you will start adding to investment. So that's what is written in the standard, and that's the practically how it happens. Straightforward, simple. Most important is the disclosure which is required, which is a very at length you have to give in the financial statements. In this associate relationship, you don't have to eliminate the transaction or a balances. You just have to eliminate the unrealized profit, because it is sitting in the P&L of that entity, and hence whatever is inventory sitting in either of the books, you have to just eliminate the unrealized profit while picking up the profit of that entity. Joint arrangement. So, IND AS 111 talks about joint arrangement. Joint arrangement is further divided into two parts: jointly controlled entity and joint venture. Okay. So, joint arrangement will be there between two parties when they have a joint control. And what is joint control is the ability to control unanimously, jointly on the entity, right, by way of some agreement or a contractual arrangement between two entities, right. So, there has to be some contractual arrangement between two entities which establish that both of them will jointly discharge their roles and responsibilities and rights so far as that entity is concerned unanimously, then it becomes a joint control. And they both will perform collectively as per the contractual arrangement. If there is no contract between two parties or two entities which lay down the principle of jointly and collectively performing their duties, in which case there will not be any joint control. If there is no joint control, you will not get into this standard. So, an example, Lilatech, Robo6 and Alien Now, 50, 25, 25 in a Great Dane. Assuming over relevant activities require a 75% vote, would Great Dane be joint arrangement in this example? अच्छा सॉल्यूशन तो दे दिया नीचे. Why they say it is not? There is no joint arrangement in this situation. There are three shareholders, 50, 25 and 25. So, whether it is a joint arrangement between Lilatech, Robo6, Alien Now, Lilatech and Robo6, Lilatech and Alien Now, Robo6 and Alien Now, or all three of them. These are the only permutation combination. Yes or no? No. Solution no लिखा है, but क्यों? डेडलॉक क्या? So, the answer lies in the next slide, agreement to vote together. इतना ही difference है. Okay. So, as I said that there has to be some contractual arrangement between two which determines that they both collectively perform their roles and responsibilities. If that is the case, then there will be some joint arrangement. Collectively they have to come and perform. So, in this example, earlier example, it's just a information where three shareholders are there. They are nowhere connected to each other. लीलाटेक आके जो भी करना है वो 50% लेवल पे करेगा, वो लोग 25% पे करेंगे, जो होगा वो मेजोरिटी पे होगा. बट देयर इज नो पैटर्न फॉलोड हियर दैट बोथ और आइदर ऑफ टू विल वर्क टुगेदर. They will do it once they have some agreement in together, and if that is the case, then there is a joint arrangement between Lilatech and Robot6, and hence it will be a joint arrangement. Now, whether joint arrangement is a joint control entity or joint venture is the next step which we need to understand. Are you with me? Okay, so then there are two concepts, joint operation and joint venture. When we say joint operation, that means the operation of an entity is jointly and collectively performed. Okay? It may not have a separate legal entity. So, for an example, this happens very often in case of oil and gas industry, where you have these oil blocks for extraction, and what happens that ONGC and GSPC will come and they will have one oil block which is acquired. Now that oil block is not a separate legal entity from the entity or a company standpoint. What is it? Is a kind of a jointly controlled operation. ONGC will say that I have expertise in extraction. These GSPC will say that I have expertise in the market and I have expertise in my people, right? I will invest this much, I will invest this much, I will put people, I will put my machineries. This is jointly controlled, joint operation, right? So there is no equity per se, there is no net asset separately identified for this entity so far as that operation is concerned, and that is the definition of joint operation. So you will not have a separate legal entity form, it may be some unit or it may be some operation which is being handled by two collectively with some agreement and arrangement for which they already lay down their responsibilities, roles, liabilities, assets and everything. So that is joint operation. The second is a joint venture is necessarily be a separate legal entity where two entities are there and then third entity is being created which is kind of a joint venture. Both entity will invest into the equity of that entity and they will perform, and this entity more or less having autonomy for so far as their operations, business, policies, everything is concerned. Ultimately what will happen that this entity becomes an independent but jointly controlled by these two entities. Again the agreement, joint agreement will mention that what is the ratio in which the investment is done, what is the ratio at which the various liabilities are being distributed, how the relevant activities will be performed. More or less it will be always unanimous control, both jointly, collectively give the decisions for relevant activities, and then it becomes a jointly controlled entity which is called a joint venture. If it is not the case, then it will take a form of joint operation. Okay. Now this assessment is very important considering that the accounting treatment is different under both the situation. Okay. Now what is the difference? स्लाइड में नहीं है, चलो इट्स ओके. So when it is a jointly controlled operation, you will do the line by line consolidation proportionately. So let's say it's a 50:50 joint operation, then one entity will consolidate 50% of all the line items into its books of accounts and the second entity will take 50% of all the assets and liabilities. Now the question arises that this is not a separate legal entity, then whether the financial information will be available or not, right? So more or less in this type of situation, the agreement itself mentioned that you have to maintain separate books of accounts so far as that operation is concerned. So it will have a separate trial balance which will be considered and consumed for the preparation of the consolidated financial statement at company A and company B level. The second is when company A contribute anything to this operation and the company B will contribute to this operation, they will do separate accounting its books of accounts separately anyways, right? And it will follow kind of a branch accounting basically. So you know that when I pay something to branch, so I will create a branch account as a control account and do the settlement, and then ultimately at a entity level that branch receivable payable generally will not arise because it's the same entity, but for better control purpose I will do branch accounting. Similar kind of accounting will happen. There will be the other, so this venturer and the other venturer will also have the separate ledger of the individual venturer in its books of accounts, because what happens that I need to contribute only 50%. If I am contributing 60%, then 10% I will say receivable from my other venturer, and 50% only I will contribute as an whatever asset or a liability I am putting in that operations account. And similar goes in the operation accounting, the ulta entry. And again at the time of consolidation, proportionate consolidation होगा, जैसे कंसोल का होगा लाइन बाय लाइन, वैसे ही होगा. इट्स जस्ट दैट 50% अप्लाई होके होगा एंड दूसरा एलिमिनेशन भी अकॉर्डिंगली होगा. सो सारे प्रिंसिपल विल रिमेन एज इट इज सो फार एज कंसोल इज कंसर्न, कंसोल एडजस्टमेंट्स आर कंसर्न, except it is a proportionate consolidation method and not the full consolidation method. Okay. In case of joint venture, which is jointly controlled entity, it will be equity pickup accounting. Just like associate accounting I said, so if at 50% it will be only equity pickup. Both the entities, company A and company B, will pick 50% of the net profit of company C into its books of accounts. So C will never be consolidated at a totality level, because both entities are like a joint venture and jointly controlling this C entity, right? Are you with me? If any entity says that I have a control, तो बाकी दूसरी entity का वो associate accounting हो जाएगा, but इसके लिए फिर control हो जाएगा. Yes. So two ways, as I said that when you have an operation and prepare the trial balance separately, then what will happen that you will just pass certain entries of giving money to that operation, transferring like a branch accounting, right? And all the assets liabilities will be maintained in that operation as a separate unit. Let's say you are following ERP in SAP, you will just create one business center, cost center for that matter, right? Or a profit center for that matter. So this entity will not put everything as a asset liability in its separate books of accounts. It may just create one or two entry for the initial investment only, and that's the reason this is how it will be consolidated. Otherwise, I am with you that if they are passing all the entries of putting things into this, then there will not be any consolidation required. It's just a intercompany elimination will happen, and the other venturer settlement reconciliation will happen, and accounting will happen. That whatever is receivable and payable between venturer will happen. No, it's not a console financial statement, it's a entity's separate financial statement. It's just that the procedure will be this, which they have to follow.
Like in capital transaction, they are taking into the books of accounts as a cash flow contribution.
Yes. Right? So this is a good point. Did everyone understand what he said? अगर ऑपरेशन है, सेपरेट एंटिटी नहीं है, तो मुझे कंसोलिडेटेड फाइनेंशियल्स बनाने की जरूरत नहीं है. इफ यू रिमेंबर माय इनिशियल कन्वर्सेशन, व्हाट इज द रिक्वायरमेंट ऑफ प्रिपेयरिंग कंसोलिडेटेड फाइनेंशियल्स फ्रॉम द कंपनीज एक्ट एंड द सेबी LODR standpoint, right? Because it is my own entity and an operation kind of a branch, so it's a separate entity, separate books of accounts only, right? And it's a standalone financial statements only I will prepare. It's just that the procedure is accordingly to be done, which is kind of a proportional consolidation method. Subsequent.
Becomes then is it from that effective date when it becomes, or again say you have discovered oil, you have discovered some energy source which is
No. So what will happen? Let's say you are 50-50 joint venture. Now you are further acquiring 20%. Let's say, okay, into that entity. So now you are controlling that entity. So the day on which you have further acquired 20%, you will do the acquisition accounting entries, calculation. You will do the fair valuation of purchase consideration at a total level, at 70% level. You will reduce the net assets of 70% at a fair value. You will do the NCI reduction 30%, and you will reach to a goodwill, which is a day one goodwill when you acquire that control from the common joint control to the control as a subsidiary. Operation, you don't have to do a control assessment. It is more of a same entity only, na? In operation you will not have a 20%. In joint venture, if you are saying, is a different story. Associate to joint venture होगा और joint venture से control होगा, subsidiary होगा. बट ऑपरेशन में तो क्या है कि वो ऑपरेशन है ना, इट डजेंट हैव इक्विटी शेयर्स, सो वो क्वेश्चन आएगा नहीं.
Sorry to repeat, but suppose we are trying to discover some minerals or oil or whatever
Right.
resources there. We have pooled our resources that you bring, like you said, your technical resources, I'll bring in the machinery.
हाँ हाँ.
Now, by good, and it is a joint control, we have right now decided I will be doing my part of it, you do your part of it. Now, by some good fortune, we have discovered some mineral or some energy resources.
Congratulations.
So now we decide that okay, now we have incurred all of this. Now we make it into, now we continue our relationship further.
हाँ.
So the point is that it starts off from that particular date when we have it, or does it have any linkages with the past?
No, no. So this accounting will happen starting from the day one, and it will continued. You are still having an operation only, even if you have discovered minerals.
I'm saying now I'm becoming it into a
Separate entity. So then you are saying that I am floating new entity and transferring these all net assets. So it's kind of a demerger in that case, that entity A and B both demerge their unit of operation to a separate legal entity, and that accounting will happen.
yeah, because as you mentioned earlier, it is not necessary to have a separate entity in case of a
Correct. So this is practically happening, that company A and company B will take the equity investment into this entity, new entity. All the operation related net assets of both will go and sit in the separate legal entity which is created now, which was earlier an operation.
let's say it takes 2 years time, so I might have expensed out all of those expenses which are there. Then what do I do in that?
No, you will take only net assets of that operation on the date on which the new entity has been floated, and the equity is transferred to the A and B separately. Ultimately, whatever expenses have been gone is a part of your P&L and reserve surplus only. जो भी होगा वो नेट असेट्स ही जाएगा. ऑपरेशन के जो नेट असेट्स है वही ए और बी में से जाके वो एंटिटी में जाके बैठेगा ना. So you are converting an operation or kind of an LLP, for an example, to an company. So कंपनी को आज मैंने फॉर्म किया तो उसमें वो ऑपरेशन के नेट असेट्स आके बैठेंगे यहाँ पे, और दूसरी साइड पे सो असेट डेबिट होगा, लायबिलिटी क्रेडिट होगा, और दूसरी साइड पे शेयर कैपिटल इक्विटी जो इश्यू करेगा कंपनी ए एंड कंपनी बी को 50/50 वो क्रेडिट होगा.
Not stretching further, my only point is I'm just picking up from what you said. Like suppose you are only bringing your technical resources for that.
हाँ हाँ.
So only in terms of my technical skills with that. So in that case, I will not have any asset. My expenses would have been locked up over a period of 2 years. Then in that case, what do I bring to that organization in terms of when I start that new company?
No, but then you are taking this in isolation. Na? The agreement would speak that if I am getting all the technical and everything, right, what is my game in the scheme? How much I will get it? So that should be part. So it will be all together and not only single.
So basically, sir, in mineral rights production sharing contract says everything into that, and if you whatever he says, if you find some mineral rights, na, government is the third party to that agreement, so you will never allow to create another company.
Agree.
So technically, it is not possible. Production exploration license will be in the same company. It will not go transfer to another company.
बिल्कुल bang on. And this is not happening only in this mineral and all. It also happens to the boot contracts where the jointly you are creating the roads infrastructure, bridge infrastructure and all. वहाँ पे भी ये सारी चीज़ें होती है और वो नहीं होता है. Even green energy में भी this all types of transaction happens at a SPV or operation level also. So then you will have to look at the concession arrangement between the government and government. When you say, then it's an authority like PNGRB is one for the gas. Then there are other authorities for specific businesses basically.
Sir, investment in LLP. Suppose I have invested in the more than 50% in LLP, having the profit 50% or more than 50%, and capital contribution also more than 50%. Then in consolidation, first of all, I will have to convert my LLP balance sheet in the IND AS, and then it is the same case will be in the joint venture.
Yes.
All the joint venture.
Yes. So what will happen in case of joint venture and associate? You will pass limited entries to reach to IND AS profit or loss, right? So Basically, see, one leg goes to P&L, the other leg will definitely go to balance sheet. So it's not like that I will pass only one-sided entry of P&L, but at least some memorandum working will be prepared where you will say that I will adjust my IGAAP profit to IND AS profit, and that you will pick it up saying that I have followed the IND AS, I have applied the uniform accounting policy, I have done the profit elimination, and whatever is the net attributable profit IND AS that I am picking up, and that will shown as a disclosure also, that what all adjustments are there from the statutory financial statement to what you are picking up. Fit for consolidation. Correct. So accounting policy is uniform. You have to follow at the year end. Year end has to be same except 3 months difference. And if it is more than 3 months difference of year end, then you have to adjust the period related adjustments and draw your balance sheet and P&L to match your parent's year end financial year. Okay, so more or less we are done with the the overall concept for consolidation, joint venture and associate, right? In case of control, I just reiterate control definition, the relevant activities, power over it with variability of return, have a linkage between both of them, substantive rights, protective rights, assessment, look at the minutes of the meeting, shareholders agreement, other supply contracts, and based on that you make the assessment whether I control it or not. It has to be a unilateral control. If you have a unilateral control, then you will consolidate it as a subsidiary. If not, you will get into a IND AS 111 for joint control. When you have a joint or a common control joint control over the entities by 2 persons or 2 entities, which is governed by some agreement or arrangement. Again, you will look at it whether it's an operation or a separate legal entity, whether your scheme of the game is into the net assets of the company of the operation or the overall net assets of the company separately. If it is operation, proportionate consolidation method. If it is joint venture or joint entity, jointly controlled entity, then it's a equity pickup method. Same goes for the associate. When you have a 20% around of your investments into the equity of the company, and you have a significant influence by way of some of the indicators like a board representation or a supply contract, or you can influence some of the operational policies, or there is a protective right given to you, then it's more of an associate accounting. It's a equity pickup accounting. The goodwill anyways arisen in case of consolidation is tested for impairment. The NCI calculation is done with 2 methods. One is proportionate net assets of the company, and the second is directly fair value of the NCI can be taken up. Both the methods are allowed, and you can choose cherry pick the same for different transaction in your books, in your financial statements, and you have to disclose the facts. Then we have seen the balance elimination and transaction elimination, the flavor of foreign currency transaction elimination, how it happens. We also looked into the non-current assets transfer, where the profit is eliminated and the depreciation on the profit is eliminated. Profit elimination so far as the inventory is concerned under all the scenarios. Then majorly the accounting policies is required to be uniform. The exemptions available for consolidation, where we said that the principle of exemption under Companies Act as well as under IND AS 110 are same, the intermediate entity which I spoke of, right? And we also spoke of the overall accounting treatment of all 3 at a go, which will be done at the year end when you have the relationship subsisting on the reporting date. Now, anyone having any doubt or question so far as these concepts are concerned? I tried to touch more or less the example practically applicable and available, or I have experienced or observed during my 15 years of career, and try to correlate with. Technically, this is, if you read the standard bare text, technically it is very difficult. the way the language is written so far as control, joint control and other things are written. So any question? Any quick feedback? Yes. Okay, so I think your question is more from the common control transaction standpoint, right? Yeah. So see, this is very common practice when we have clients where they have a HUF on top or trust is on top, which are handled by those family members who are the promoters, and then they have floated so many entities below that, right? And below that also there are entities, and they are a very complex structure. Okay. Now it becomes difficult at one layer down to decide that whether this is a corporate restructuring that is happening between two entities or there is really a business combination which is arisen. Okay. And the assessment becomes very critical from that standpoint. So यहाँ पे main important चीज़ यही देखनी है कि पहले जो structure था where दो entities are different ultimately hold by some trust or HUF or a main entity, parent entity, और उसके बाद what will be the structure of that trust and how much they will hold. If they are more or less same, okay, controlling perspective, then it is a common control transaction. It is not a business combination under 103, and where you will do the book value accounting. Now this type of situation arises when company has a mala fide intention to create fair value in the books and inflate their books. Okay, so they do that दो एंटिटी अपनी घर की है ना, दूर दूर तक दिख नहीं रही है, बीच में 5 एंटिटी का लेयर आ रहा है, ऊपर ट्रस्ट बैठा हुआ है कॉमन कंट्रोल का, और यहाँ पे ये एंटिटी ने ये एंटिटी को बेच दिया बिजनेस, तो ये फेयर वैल्यू अकाउंटिंग करके इसको अपलिफ्ट कर दिया, फिर उसको लिस्ट कर दिया, या ये ऑलरेडी लिस्टेड है, इसको यहाँ से लाके डीमर्ज कर दिया, वो ऑलरेडी लिस्ट हो गया फेयर वैल्यू करके, बैकडोर लिस्टिंग. सो ऐसा कर बहुत ट्राई करते हैं, बट दिस असेसमेंट बिकम्स वेरी क्रिटिकल एंड इंपॉर्टेंट वेर यू विल हैव टू गो थ्रू द एंटायर लेयर of this group structure, and it is difficult assessment. It is not straightforward answer. No, so consolidation will not happen at a trust level or a HUF level. It will remain to the next layer where the company arises, right? But I tell you, the Tata or Adani's or Reliance and all, at a trust level also they look at their financial statements. But those are the management numbers. There is not required to publish anywhere. And there are special engagements and assignments for which the CAs are hired and companies are hired, Big Fours are hired to do those consolidation. So they apply these principles only. But those trust related या HUF related financial statements never go anywhere. So वो चीज़ है. Anything else? Sorry, P&L? Cash flow will be line by line consolidation after doing elimination adjustments. P&L सेम, P&L भी लाइन बाय लाइन कंसोल होगा सब्सिडरी में, एंड एलिमिनेशन के कॉलम में से सारे एलिमिनेशन असेट ये ट्रांजैक्शंस के एलिमिनेशन होंगे, परचेज एंड सेल्स के, एज वेल एज एनी अनरियलाइज्ड प्रॉफिट विल आल्सो बी एलिमिनेटेड फ्रॉम दैट. यस, सो 30 सितंबर के बाद यानी 1 अक्टूबर से 31 मार्च तक के 6 महीने के P&L का ट्रांजैक्शन कंसोलिडेट होगा और एलिमिनेट होगा. और डे 1 पे 30 सितंबर पे गुडविल कैप रिकग्नाइज होगा, NCL रिकग्नाइज होगा, और वहाँ से कंसोलिडेशन शुरू होगा तुम्हारा. एंड यू विल हैव टू सेपरेटली मेंटेन सर्टेन एडजस्टमेंट्स एट अ कंसोल लेवल विच आर डिफरेंट फ्रॉम द स्टैंडअलोन लेवल. लाइक यूनिफॉर्म अकाउंटिंग पॉलिसी है, या वो एंटिटी आई गैप में और अभी इंडेस कर रहे हैं, राइट? सो दोज ऑल थिंग्स विल बी देयर. No, I'm not getting. Disposal of investment, right? Okay, so at a standalone level, whatever investments you have sold, it's a day one gain and loss. Consol में से वो पूरा का पूरा net assets you will pass one entry of net asset reversing and net gain will be accounted for. So whatever, so basically simple है. At a standalone level, you are carrying 80% investments, वो तो simple है. 80% बेच दिया मैंने, जो भी, हाँ, वो प्रॉफिट आ गया. अभी कंसोल लेवल पे मेरे पास 80% नेट असेट्स पड़ा हुआ है और 20% का एनसीआई पड़ा है, राइट? पूरा नेट असेट्स रिवर्स होगा ऑन द डेट ऑफ डिस्पोजल. व्हाट आई एम रिसीविंग फ्रॉम देम विल बी डेबिटेड. ओके, द डिफरेंस विल बी गेन और लॉस on the disposal, and NCI will also be debited. Okay, so asset will be credited, liability will be debited, NCI will be debited. Okay, what I am receiving will be debited, the remaining will be loss or a gain in the consolidated financial statement. और वो दिन से वो consolidation निकल जाएगा, उसके पहले तक का consolidation आएगा in the year in which this transaction happens. हाँ, निकलेगा ना, पूरा का पूरा निकलेगा, पूरा निकल जाएगा एक वही दिन पे. जैसे 30 सितंबर पे डिस्पोज किया तो 30 सितंबर के नेट असेट्स मेरे को लेने पड़ेंगे सब्सिडरी के, और वो पूरा का पूरा पहले कंसोल करूंगा मैं उसको 30 सितंबर पे पहले तो, फिर उसको निकालूंगा. आर यू गेटिंग मी? यू हैव टू फर्स्ट कंसोलिडेट टिल 30 सितंबर दैट सब्सिडरी, क्योंकि लास्ट ईयर तक का तो कंसोल किया है मैंने, 24 तक का किया है. अभी 30 सितंबर का मैं ट्रायल बैलेंस लेके उसको पहले कंसोल करूंगा और वही फिर उसको निकालूंगा मैं बाहर, सो एज टू अराइव अ नेट गेन और अ लॉस ऑन डिस्पोजल ऑफ दैट इन्वेस्टमेंट एट अ कंसोल लेवल. गुड क्वेश्चन. No, it all depends. If you are going for slump sale by just doing transaction, you may not go through NCLT approval. If you are going specifically through NCLT approval, then it depends. Means there is no difference for listed and unlisted. हाँ, slump sale में तो the day on which you finalize the consideration and flown and the equity is given, from that date you will consider it as a effective date of transaction. Yeah, it will be P&L because you have disposed of that. स्टैंडअलोन में क्या कहाँ डालोगे? तो फिर कंसोल में कहाँ जाएगा? फिर तो स्टैंडअलोन एंड कंसोल सेम ही हो जाएगा ना? नहीं, स्टैंडअलोन एंड कंसोल तो सेम हो जाएगा ना, एक बार वो निकल जाएगा कंसोल में से, फिर तो वो सेम हो जाएगा. Hypothetically, there is only one entity in which you have invested as a subsidiary. So then there is no difference. So it will be in P&L only. It will be P&L.
So practically, any guidance on the date of acquisition, because if you are taking annexure C for the net asset value method, so practically any guidance if it is in between, let's say 22nd of the September. So I need to do calculate NCI on 22nd September, or I have an
No, so guidance is available, practical expedients are there, publications may mention that you can do it a nearer to that date, but generally ये सारे transaction में जो date है ना specifically, उस दिन का fair valuation generally कराते हो सारे transaction में, you are available with that. If it is a 22nd, you will have a 22nd. But अगर आपने उसके पहले के month end में ही already करके रखा हुआ है, so you can take those values also if they are not substantially different from 22nd and last 30th. There is no major event, there is no major transaction happen, and if it happens then you capture it but then you'll have to get it audited and you have a proper base to it. Otherwise acquisition date का guidance बहुत सारा है 103 में. Yeah, so should we wrap up? Done? Okay, thank you so much everyone for interactive session, the first one. So, I would end up with saying that, the benchmark and the bar has been really high. The first session covering IND AS, that to control, consolidation topic, right? So, this stage and this has a lot to see now from this level to the next level. So, great. Thank you so much for, giving me opportunity to hear, and it was a nice interactions with all of you, and I have gained a lot of experience by doing so. Thank you so much.